Good morning. Good morning, everyone. My name is Stuart McIntosh, and I'm Executive Director of the Group of 30, and I'd like to call this International Banking Seminar to order. And I would like to, first of all, ask our excellent and generous host, Luis Alberto Moreno, President of the Inter-American Development Bank, to come up and give us a few words of welcome. Luis Alberto, thank you.
Good morning, everybody. It's a pleasure to welcome all of you again here to the IDB and for this meeting of the Group of 30. Certainly, this is a time where there's no shortage of issues to discuss today, from Brexit to North Korea to corporate debt to cryptocurrencies to pensions, polarized politics, climate change, central bank independence, and a slowing world economic growth, just to name a few of our challenges. We at the IDB Group are, of course, by definition, focused on what's happening in our hemisphere, in Latin America and the Caribbean. Many of you know the recent numbers that the IMF just reviewed its growth projections and now expects Latin America to just grow 0.2% this year. If trade tensions persist and if output shows in the US and in China, and that slowdown will create shocks to the financial asset prices, could push Latin America and Caribbean countries into recession next year. And that's not just a possibility. Slowing global trade and lower commodity prices have already affected our economies. In fact, our region, in the worst case scenario, may grow as little as 0.4% annually over the next 3 years. And this would come after 7 years in which the region's GDP per capita has been stagnant. Now, that scenario would seriously complicate the required fiscal adjustment that many countries are doing, and especially Brazil, which you will hear later from Roberto Campos, the president of the Central Bank of Brazil, which is continuing on growth to reduce the ratio of spending to GDP and curb rising debt levels. It will also hamper the potential debt restructuring in Argentina and affect negotiations over its IMF program, the largest lending program in IMF history. A few of our countries understand the gravity of the situation and are starting to take the painful measures that are necessary to create new sources of growth. Last week I was in Brazil, which has taken an important set of steps towards the passage of a historic pension reform and is moving to open its economy and reduce the cost of doing business. The fact that we face so many systems risks underscores the need for a strong multilateral system. I'm sure we will have interesting discussions today about the architecture of the global financial system, and I'd like to congratulate Tharman for leading the Eminent Persons Group that recently made a set of interesting recommendations for making this system work for all. We embrace many of these recommendations here at the IDB. And without entering into too much detail, we have mobilized more resources and worked with fellow MDBs to make development banks act more as a system, as was highly recommended by the report. We have equally become far better at measuring our own effectiveness. So I share the report's view that at the end of the day, it is the private sector that will help boost growth. And I believe regional development banks are ideally placed to influence domestic institutions and improve regulatory frameworks such that private investment can grow at a much more aggressive pace than it has in the past. So we're meeting at a critical juncture, and that will take and make many of these discussions here today all the more valuable. So, as all of you, I look forward to the debate today. Thank you all, and welcome for being here with us. Thank you. Tharman.
Thank you very much, President Moreno. I'd now like to ask the chairman of the Group of 30, Tharman Shanmugaratnam, to come up and say a few words.
Thank you, Luis. Let me start by just thanking Luis Alberto Moreno, not just for hosting us today, but for hosting us over many years here at the Inter-American Development Bank. This Sunday morning session is always looked for at the end of a week of IMF and World Bank related meetings. You either go to church or you come to the Group of 30 International Banking Seminar. Not for blessings, but at least to get some very good questions. But Luis has, to be frank, been a real leader in his own region, but very importantly, in the rethinking that is taking place in multilateral finance. I found my colleagues and I, when we were working on the G20 Eminent Persons Group recommendations, found Luis to be a voice of reason, someone who was never arguing a position from the vantage point of his own interests or that of just IDB, but the interests of the system as a whole. And I really want to thank you for raising the level of debate in the multilateral community at large. You've played a very important role, and you continue to play a very important role, both with the ideas that you have been pushing for with regard to risk diversification in the system, about how we can pool together resources amongst the MDBs, and how we can work in a complementary fashion. So I really want to thank Luis Alberto Merino for his leadership. This is his last year, I know, if I'm allowed to say so, as the leader of the IDB. And it'll be the last year that you're personally hosting us, and we, of course, look forward to your successor doing the same. Thank you very much, Luis.
Thank you.
Thank you. I should also just say very briefly that I have to apologize on behalf of Jacob Frankel, who has always been with us as chairman of the board of trustees of the Group of 30. This is the first time in 35 years that he's not attending the International Banking Seminar because he had to fly off to India for an important JP Morgan event. So let's proceed straight away to the rest of the sessions. We're on a very tight schedule. And if I could invite the speakers for the first panel to please join me on stage. Thank you. Oh, thank you. Sorry. I'm so sorry. There is a little bit of formality and a photograph that we have to get over. Thank you. Well, we're right on time, so let me go ahead with the very, very brief introductions and start the first session. Those of you who are familiar with the International Banking Seminar will know that we usually start with a session on the advanced economies and then move on to the emerging economies, but I decided to switch it around this time and start with the emerging economies. And I think we do, wherever we are in the world, we have to think very hard about the situation in the emerging world, the policy challenges, and how the global environment has to make it possible for the emerging world to be an engine of growth in the years to come. We have three exceptional speakers, all central bank governors, and I'd say quite apart from being central bank governors, they've got very interesting backgrounds in finance as well as other areas. And I'll introduce them only very briefly. Patrick Njoroge, currently governor of the Central Bank of Kenya, as some of you may know, spent many years, in fact 2 decades at the IMF, in fact he was extremely well regarded in the IMF, if I might say, and then was called back to do service at home, and is now, I would say quite frankly, one of the best regarded central bank governors that we have. Viratai is Viratai Santi Prabab is governor of the Bank of Thailand, again, someone with a long experience outside of central banking as well, in commercial banking, as well as at the stock exchange. And if I might add, also someone who spent time in the social and philanthropic sector. And we've got Roberto Campos Neto in the very interesting seat now in Brazil, governor of the Central Bank of Brazil. Roberto has also had long experience, 2 decades, I believe, in Santander, and comes with a very deep understanding of global markets. So we've got a good group. I think what we'll do is we'll start with Patrick. We'll then move on to Viratai, and then we'll come to Roberto. Patrick.
Thank you, Taman, and good morning, everybody. Delighted to be here in the G30. This is not a forum that I'm used to, and very glad that I'm in your midst. I want to make a few points about where we are in the global economy and how economies such as ours, but not just ours, but more generally as well, where they are in this sort of progression that we are on. Our country, Kenya, is really it's not an emerging market yet. It's one of the so-called frontier economy, but it is actually very involved in the sort of international relations and indeed also in international capital markets. So the perspective there is obviously interesting because it shares a lot of concerns, the same as other emerging markets and indeed most of the G30 members. So the first point I want to make is what we are seeing. I think all of us were shocked, to say the least, about the reduction in expectations of the global growth that the IMF now is projecting this year, 3%. And if you looked at their table, the reduction in growth rates was across the board. As a matter of fact, looking at those numbers, that table, there are only 2 rows that didn't have negative numbers. So the slowdown is quite dramatic and indeed, should we say, quite expanded in terms of geography and so forth. My takeaway from that, aside from the usual concerns that this raises, is that maybe we have now realized that we may have underestimated the impact of tariff barriers and all the other, let's say, uncertainties that are in the world today. The Brexit concerns, for instance, which are much more pressing to us. All that, I think, has led to the reduction in the projections. But I think for me, the issue is maybe we were whistling into the, whistling in the dark, as it were. And now we are clear that, yes, we can't get away from the significant reductions that we expect to see. And perhaps we will even see more dramatic reductions or slowdown in growth looking forward. I mean, we may not have hit the bottom. And that, to me, is a big concern for other reasons that I'll mention later. A second point in this is the significant it underscores the deep distrust in globalization, which in my mind is something that is quite worrying. And that's something we'll come to in a minute, because the benefits of globalization, I think we all understand this, but the other side of the coin, which is the losers, what we do with the losers, meaning the losers in globalization, that problem has not been dealt with completely, and we have seen the impact of it, or let's say it unfolding even in terms of migration and other pressures, including, of course, the rise in populism. So what's the point for us? I think for me, it's important to appreciate, as we had always done as economists, that maybe the impact of reduction in well, trade, or should we say, impact of tariff barriers, we generally understate that. I think that's a standard economic result, at least empirically. But I think for me, the bigger concern isn't so much trade. The bigger concern for us is really what is going on in innovation. And now there's a sense of bifurcation. I think a classic question here is what's happening in the G5, whatever it is, the technologies, right? The 3G or the 5G. Yes, that's the word. I guess I'm stuck with G20, G10, G24, G1 actually. So I don't know, whatever the G's are, well, okay, the 5G technology, yes. And I think the point for us is, particularly from Kenya, we are very innovative. I think you've all heard about the innovations we are having, but we have been riding on improvements or innovations that are ongoing in the technology space. Now we are unsure which way to go. And I think the entire world will have to pay a deep price for this if indeed we don't get it right and if there's no clarity as to the direction of the technology innovations. So that to us is a big issue. Another point which I want to raise is the decline in the spirit of cooperation. And I think this is a point that Taman has made in many, I guess it's part of the reason we are here and why they've been working on this project of eminent persons. But I think that to us is a big concern. And frankly, if I were to say what one thing that bothered me during this meeting, so this sort of visible, almost palpable decline in the spirit of cooperation. I haven't been to all meetings, but the ones I've been to, there's a general sense of malaise, and that I think is quite troubling. So what do we do? I think in terms of priorities, and with this I'll finish, the priorities of creating policy buffers remain with us. We have to pursue good policies. There's no way of, you cannot go around that. Whatever those policies are in monetary, fiscal, and I think the demonstration effect of countries that are actually pursuing positive policies is something that needs to be highlighted. And I think Brazil and others are pretty, even under difficult circumstances, those examples need to be highlighted a lot more. I guess I missed that during these discussions. The other ones are, another point that need to be, another priority as I see it, is this issue of regionalism, meaning obviously we have to insure ourselves, self-insure, but also even as we do not find that spirit of cooperation internationally, we need to, let's say, nurture it in our regions. And in our case, in the East African Community region, we have been pursuing this cooperation of the community. And indeed, more generally in Africa, there is the African Continental Free Trade Area, which is the second largest free trade area, obviously after the WTO. And I think the urgency should be seen quite clearly. Of course, we should not abandon the overall international cooperation like in the Bretton Woods institutions and others, but I think let's not ignore what we could do and benefit from the region. Finally, there's a lot to be done, a lot of work that needs to be done directly to improve the opportunities for those that you may call them disenfranchised, the losers in the globalization sort of direction, or losers in globalization. And those, I think, there are many. But I think we cannot allow, we cannot allow sort of a general mantra of, rising tide, we raise all boats kind of thing. Rather, we should have specific policies that are tailored to the losers in the globalization equation. And from our perspective, I mean, that argument goes in all sorts of ways, right? So for instance, from our perspective, we've been working on financial inclusion. As you know, that can be done in all sorts of ways. We've been using technology to improve that, and actually have done remarkably well. But I think the opportunities are there, and I'm sort of a cheerleader of technology, and particularly digital technology. And I think for Africa, there's a huge opportunity that is there. And if you begin in Africa, you also go to other countries around the world that maybe haven't fully benefited from the spirit, or let's say the technologies that are with us, the digital technologies. And just to give you a simple example, you think about banking, right? And we have done very well in this area. And now most of us do our banking on digital platforms, at least in Kenya. And the reason for that is, or one of the elements there is that the penetration of digital devices at this moment is something like 80%. Over 80% of the people, adults, have actually a phone. And there are many more, and there's an ecosystem that has developed around the digital financial services area. So my point is, again, going back to the losers and finding ways of benefit, of bringing them along, not just as a social project, but knowing that they will increase, they will actually add to growth, they will add to productivity and, should we say, dynamism of our economies. So in sum, there's a lot of work to be done. The priorities are clear, but I think we should not be, in my mind, we should not be, we should take courage and not be cowed by, I guess, the cold wave that now pervades Washington. Thank you, Taman.
Thank you very much, Patrick. Very well put. Thank you. Governor Viratai.
Thank you very much, Taman. A very good morning to all of you. At first, I would like to thank the Group of 30 for inviting me to participate in this very important panel. And I particularly like the topic of this panel, Priorities for Emerging Nations in the New Global Environment. Patrick has nicely laid out challenges for emerging markets, ranging from technology, globalizations and anti-globalization, if I may add, climate change, income inequality, and many others. If I may speak from a perspective of a central bank governor, I would like to highlight 3 issues that might be relevant to emerging market economies. Firstly, it's related to the point that Patrick touched upon, helping the losers. And the losers that I would like to focus on are the small and medium enterprises. As we all know, supply chain disruption has started even before the current trade tension going on. Technological changes have large impact on the way firms operate. And SMEs, they don't have the resources similar to large corporations, and they're not in the same position to take advantage of technology. During the past decades, large corporations have also benefited from the access to very low-cost financing, from access to debt market, while the medium-sized enterprises cannot have access to the same low-cost financing. They have not benefited much from the low interest rate environment that we have seen. And market dominance power have also increased during the past decade. Large firms becoming larger, they have much more pricing power, they have much more competitiveness. And on top of all these changes, we have the trade tension, the ongoing trade tension that has very large impact on supply chains. So the challenges for the medium-sized firms are very important. Medium-sized firms are backbones for emerging market economies, particularly the manufacturing medium-sized firms. If we don't address competitiveness of medium-sized firms, and the whole economy, the structure of the economy could change. It will impact the investment pattern. It will also impact the employment pattern in our societies, because as we all know, small and medium enterprises are the largest source of employment in emerging markets economies. There are a lot of things that governments can do to help the SMEs, and I see SMEs capacity building as one key area where the government can be more proactively involved. These include things like proactive consultation and coaching. We also need to provide incentives for productivity enhancing investments for the medium-sized firms. We also have to step up our mechanisms to prohibit the abuse of market dominance power by large firms to make sure that we have a competitive landscape whereby SMEs can compete. We need to promote digital adoption that Patrick also alluded to. And we also need to eliminate outdated laws and regulations that have hindered SMEs' competitiveness. Although enhancing SME competitiveness might not be something that central banker it's not a direct mandate for central bank, but at the Bank of Thailand we see this as an important area, and we have also stepped up our focus on SMEs lately. We have worked with the banks to develop payments platform, digital payment platforms for SMEs to lower the cost of payment services, to improve payment efficiency, and most importantly, to set the ground for moving towards digital finance. When we have digital payments and we try to move all the transactions onto the digital world, that will provide the important input into digital finances data. We have also set up a new database on SME loans contract by contract to have a better understanding of how SME is financed and the evolutions of SME credit risks across different firms, across different sectors. We have also introduced new foreign exchange hedging mechanisms for SMEs. For a small open economy like Thailand, volatility in the exchange market is becoming a real challenge, and SMEs need to have a better ways to hedge against all these foreign exchange rate risks. And lately, we have to encourage the bank to preemptively reschedule and restructure loans to the SME to help the SMEs go through this very difficult transition period from technology disruptions, from finding new business model, and also to deal with the ongoing trade tension. So that's my first point. My second point is looking at a more global financial market perspectives. For emerging markets, we have to deal with financial spillovers. If you look at what has happened during the past decade, capital flows, especially portfolio flows, have become much larger and much more important than current account flows going into emerging markets. And these capital flows, a significant portions of them are non-resident activities. For financial returns, they're not very much related to underlying economic conditions of emerging market economies. And they have been largely driven by sentiment of global financial investors, sentiments of portfolio managers globally, driven largely by how these global asset managers see the stance of monetary policies of advanced economies in particular. These are very different from the traditional textbook determinants of capital flows that would focus more on conditions inside the emerging market or interest rate differentials. And this has become a real challenge for us. If you add on top of that, there have been a lot of financial engineering, derivatives products, and algo trading in foreign exchange trading. And that has created a lot of volatility in the foreign exchange market. So at times, exchange rate could serve as amplifier of shocks and capital flows instead of being stabilizer of shock and capital flow like we used to learn in economic classes. When capital flows are driven mainly by by speculative returns or by global asset managers and driven mainly by the global financial condition as opposed to economic fundamental of the recipient countries. This might be small in terms of the global capital market scale, but they're very large in emerging markets economy. If you compare that with the size of capital flows in and out of emerging markets with the size of foreign exchange markets that we have, they can have real impact on the movement of the exchange rate. And the movement of exchange rate is an important channel for small open economy, can have real impact on profit margins, real impact on the competitiveness, real impact on the survival of exporting firms. And it could also undermine financial stability as well. In addition, all these spillovers coming through global excess liquidity, it could have impact on monetary policy stance of emerging markets. In the low for long interest rate environment, emerging markets may also need to be careful when they decide on monetary policy decisions. They may need to follow advanced economies in delaying the normalizations of monetary policies to avoid appreciations of their currency. And because of these spillovers, monetary policies of emerging market central banks could be distracted from the core mandate of the domestic policy objectives. I think the delay normalizations in the low for long and negative for long interest rate environment could exacerbate financial stability risks, as we have heard from many panels during the past week. At this time in particular, when debts, household debts and corporate debts are historic high. Emerging nations, we have also another complication because we have large non-bank financial activities and a lot of shadow banking, non-bank financial activities are outside the perimeter of financial regulators, and we cannot count on the use of macro-prudential policy to address these non-bank financial activities. I think financial spillovers need to be addressed at multiple levels, starting from the domestic level. Financial stability has to be given a more prominent role in monetary policy decisions. And again, at the current juncture, not only the historic high debts, we also have subdued inflation, which means that monetary policy can also look at other objectives apart from inflation target, which is financial stability objective. Emerging markets also need to equip themselves with policy tools to deal with rapidly changing capital flows. And these tools encompass macro-prudential policies, micro-prudential policies, capital flow management measures, and at times, foreign exchange intervention. And that's the domestic level that we have to get ourselves prepared for to deal with capital flow and spillovers of global excess liquidity. At the international level, we also need to recognize the changing landscape and the impact of financial spillovers on emerging markets. And if I may say or propose a few things that we might consider for dealing with these spillovers at the international level. Firstly, I think the burden of adjustment needs to be better balanced, needs to be proportionately shared by both the source country of capital flows and also the recipient countries of capital flows. If you look during the past decades, the recipient countries of capital flows have borne more of the burden of the adjustments in dealing with financial stability risks. And also we have been at times restricted and reproached in our responses to capital flows when we want to impose something like capital flow management measures, while the source country of capital flows have full flexibility in their conduct of monetary policy. So in this regard, I very much welcome the fund's movements toward integrated policy framework that looks more into countries' characteristics and country circumstances, allow countries to have better mix of policy tools to deal with capital flows. The second issue that might be useful at the international level is that the assessments of global imbalances and implications for currency valuation need to adopt a broader view that takes into consideration not only current account imbalances, but also capital flows, which has become much more larger and much more, and have much larger impact than current account flows. Taking a narrow perspective of current account imbalance alone could lead us to a policy misstep. And thirdly, on international coordination to deal with spillovers, central banks should have a collective voice on how much central banks can do, and to what extent further monetary easing can prop up the economy in the current environment where the economic slowdown is driven mainly by trade tension and uncertainties. When we think about policy space, monetary policy space, we often think about zero lower bound, effective lower bounds, or the optimum size of central bank's balance sheet. I think we should also think about what I would call financial stability lower bound. How much additional financial stability risks that we should be willing to take on board when we make decisions on monetary policy. And the coordination of voice of central bank is very important because this will help set the right expectations among financial markets. The financial market would have a realistic view of monetary policies and not expect central banks to engage in further excessive easing that might result in long-term financial instability. And my last point that I would like to highlight is related to the importance of multilateral framework that Patrick also alluded to. In a world that is becoming more polarized, both geopolitically and economically, multilateral frameworks that have worked so well for us in the past, as we all know, recently got challenged by gravitations towards inward-looking policies and also bilateral economic relationships. And that has sent shock waves to emerging markets. The drift towards bilateral and trade-focused international economic policies, which bypass existing channels of trade conflict resolution, severely undermines global governance of international trade. And if the world is moving towards bilateral economic relationships, emerging markets are at a difficult situation because we have little bargaining power against the large countries when we have to engage in bilateral economic relationship. And that could result in trade distortions and uncertainties that lead to inefficient allocation of resources. In addition to the direct impact on trade, I think the bilateral and trade-focused thinking could lead us to another serious implication, especially from the perspective of macroeconomists and macroeconomic policy maker. I think I'll give you an example that why I think this is a serious implication, because the bilateral trade focus or bilateral view of the world could distort our macroeconomic policy framework. The global imbalance analysis illustrates this issue very nicely. The existing framework that was developed before the global financial crisis, and we have adopted this framework internationally, has been pivotal in the way we make policies, we analyze global imbalances in the past. This framework, I have talked about the shortcomings of the framework already, because they focus only on current account balance instead of looking at capital flows at large, when capital flows are becoming much larger. But I'm afraid that instead of moving this thinking forward in the current environment, it would be even more difficult. Even the existing current account-based framework is being challenged by the bilateral view of the world that focus only on bilateral trade, not even current account, but looking at bilateral trade. A currency intervention assessment framework that is adopted by some jurisdiction is focused mainly or narrowly on current account and bilateral trade balances, and disregards other type of fund flows like portfolio flows. And this is a thinking that could distract us, macroeconomic policymakers, from macroeconomic reasonings. But this is a thinking that emerging market policymakers need to be prepared for in the new global environment. So I'll stop here. Thank you.
Thank you very much. That was very useful, Governor Virotay. Can we move now to Governor Campos Neto?
Thank you, Mr. Tharman. Thank you for the invitation. I thank the BID. Thank you, Luis Alberto Moreno, for the invitation. I actually thought I was the only one going to speak about technology, but I think Patrick stole my scene here. Starting with the global scenario, I think it's pretty safe to say that the trade was a major contribution to the growth in emerging markets in the last couple of years. It's also safe to say that trade was one of the major contributors to reduce inequality in emerging markets. It's also safe to say, as we saw in the presentations in the last days here at IMF, that the growth is going to be more and more tilted towards emerging markets. When we analyze the actions taken in most of the developing markets, there's a guidance towards lowering rates and using more unconventional tools, more and more. What that creates, in a way, is an inflation or a growth in prices of assets. But when you have a system with full employment, it's very difficult to see that going into benefiting the lower classes. So there was an extent to how much that can work. And then there was all this talk about fiscal policy. And for us who live in emerging markets, in the case of Brazil, fiscal policy resulted in a benefit in the short run, but it created a lot of misallocation of resources, and we're now paying a high price for it. I will derail a little bit now because I wanted to talk about how the central bank can help the financial system in Brazil create an inclusive growth in the next couple of years. So I will derail, but I'll get back to what I should be. So telling a little bit the story of a financial system in Brazil, we are a country that survived many, many years with double-digit inflation, sometimes triple-digit inflation. So the banks learn how to deal with inflation. It's a system that's, the technology was all built around surviving with high inflation and high interest rates. Most of the banks lived off financing the government. The client was just an accessory for most of the time. And then, more recently, we started to see stability in the financial system. The banks developed systems to finally attend both companies and individuals. They became companies involved in financial services, and the system became very concentrated. It was very hard to survive if you had a bank in Brazil that had less than 1% market share. And after the financial crisis, that actually got intensified a little bit. When you look at what's happening lately, there is one phenomenon that I think will change everything. Will change the future of financial intermediation, which is the rise of technology. If we think about the way computers being doubling its capacity every 12 or 18 months, what the technology people call the Moore's Law, this keeps going exponentially. At the same time, the cost has the inverted tendencies. In other words, it's getting cheaper and cheaper. So what has happened lately? All of a sudden, it's very cheap to produce data. It was never that cheap to produce data. But then right after that, we realized it was also very cheap to store data. You can store data at the cloud for 1% of the price that used to be a long time ago. But then the great step in the whole process was when it was very cheap to manipulate data. So first it was cheap to create, then to store, and then to manipulate. And then you start to see the financial industry changing a lot. You started to have artificial intelligence in many places, in management, in attending the individuals, simplifying the process. We now have blockchain transferring money from place to place. You started to have the period of the fintechs. And then the question is how the fintechs interact with the banks. Well, what I think, and we always say that in Brazil, is I think we are in for this, what I call the 5D of the financial system in Brazil, which is basically desbureaucratize, demonetize, digitalize, disintermediate, and democratize. So these 5Ds, I think this 5Ds is what the revolution that we are taking, and it's going to accelerate exponentially. But how does the central bank see that? How can we use that to the benefit of the population? How can we create more credit in an inclusive way? So that, I think, was the challenge. We spent a long time designing a program to attend just that. We divide everything in 4 dimensions: inclusion, competition, transparency, and financial education. and what we call a process of democratization of the financial market. When you talk about inclusion, the main actions that we are taking, and some of them have advanced already. The first one is the microcredit. Microcredit is very important. We are facilitating microcredit. We are facilitating the opening of platforms to do more microcredit. We've had great experiences in many countries in emerging markets. It had to do with technology. The average ticket of the microcredits is very low. If you don't have a good platform, you're not able to prosper on that. So we're incentivizing microcredit. There is going to be a law announced in the next couple of weeks. We think that we will hit between 2 and 4 million people in microcredit. The second one is the cooperative. The cooperative, especially in the agro part. Cooperative now in Brazil is around 8% of the credit. We have a target to put it at 20% of the credit in 4 years. So we already took some measures for cooperatives to have cheaper funding. They increased the funding just in the last couple of months in more than 20%. You started to see cooperatives opening branches where traditional banks are actually closing branches. So I think that process is in place. But it's also important to democratize the access for foreigners and for international platforms. So we created what we call the simplification of the FX process. And this process has 3 phases. First is simplifying, and there is a project that's already in Congress waiting to be voted. It's based in collapsing 40 old laws. Most of our FX laws in Brazil are dated between 1920 and 1950. We are simplifying all the laws, putting into something that's going to be easier. That should cheapen imports and exports by more or less 50 basis on average. On the top of that, we are going to open for every company to be able to do FX. Today in Brazil, you can only do FX transactions if you are in the financial system. That's the first phase. The second phase is an internationalization, and then we want to have a convertible currency at the end of the process. There is also many initiatives on capital markets, and I won't have time to talk about every one of them, but it's basically simplifying process for private equity, for the startups of real estate funds. We have the Sandbox project that's ready and is going to be presented soon, so we are advancing with that. On being more competitive, which is another dimension that I want to explore, we have the instant payment system that we will be implementing by 2020. We talked a lot amongst us central bankers about the digital currency and the whole process. And the question that I always ask myself is, if you have an instant payment that works well in the country and that it's centralized and everybody operates in the same system, and it's fast, and people can trust, I think there is a tendency for the demand for a digital currency to diminish. So the instant payment will be ready by 2020. The second action that's very important is one of the big barriers of entry for small fintechs and small companies to democratize the process is the monopoly of data. So we have an open banking system in process. The first design of the open banking was ready by last Friday. We're going to start implementing that. We also created new rules for fintechs, and basically we divided them in 2. The first one is P2P, and we already have some operating in Brazil. And the second one is a platform of credit that you can do credit with your own resources. Since we started that, credit grew an average 300% a year on the platforms. We think that will continue to grow, and it's a process of one of the 5 Ds, disintermediation, to lower the process. A lot of the costs associated with credit in emerging markets has to do with asymmetric information. If you can remove asymmetric information, you can lower the spreads. So microcredit and small niches of platforms, they tend to diminish the asymmetric information, so that's where we're going. Also, we have to have new rules for organizing collateral and guarantees. Part of the reason why the spread of credit is so high in Brazil is because people don't really see or don't trust, or there is not a legal framework that protects the guarantees. So we are working on that. And then the 2 last things. One is Brazil has a very high reserve requirements, so we are reorganizing the system so that we can live with lower reserve requirements. I don't have a lot of time, so I cannot explain the mechanics of the system, but basically it will enable us to free in the economy a considerable amount of resources. And finally, one aspect of the Brazilian economy is that we have very, very low leverage in the mortgage market. on average, 96% of everything's paid for. But these people who have their house paid for, they're not able to use the houses as a collateral to cheapen the loans. The process of the product called home equity is very, very complicated in Brazil. So we think that Brazil, the real estate market is just a one-way street. You can finance houses, so you can put the equity of real estate in your portfolio, but you can never get out of it. So we want to facilitate that. We want to make sure that people have this, this way of cheapening the loans. We adopted some measures. When we started the project, in the very beginning, we thought we could lower interest rates from 150 to around 16% if people were able to use their houses as collateral. It turns out that last week there was a bank that started doing that at 13%. So it's lower than I expected and sooner than I expected. One other thing is to be able to securitize things, and we talked about that in one of our meetings yesterday. Banking systems, when they do loans for real estate, usually they sit the loans until the end. Why is that happening in Brazil? Was basically because the index of the loans was something that was not replicable and not hedgeable. If you have something that you can replicate and you can hedge, you can securitize. So we changed the indexing of this to every loan, most of the loans now will be indexed into inflation. When we did that change, we thought the demand would be around 1 billion from the time that we changed to the end of the year. That cheapened the first installment of the entry installment to get a house by about 35%. To our surprise, we thought we would do 1 billion in the whole year, and we did 2 billion in 1 month. So that's also something that is taking place. And then finally, on financial education, I think it's very important, and I think Patrick here touched on the technology issue, and Ken has done an amazing job. I mean, we look at everything that we've done and how you progressed, and the way you have the system which is interoperable with the cell phone. And we are talking about, how can we promote financial education in a more widespread basis. And then that has to do with technology and creativity. So we have systems, we will create systems. One of them is people will actually get a better FICO score if they take financial classes. So we are creating this FICO score, which is a unified FICO score, and people will be able, so that you can incentivize people to take that credit. The other one is having like a point system, like a mileage system, in which you can go there and you can take the class and you can actually earn points, and then you get financial discount in financial products in banks. And the third idea, which I think is more advanced, is we will open all the branches of all the banks for 1 day. And people on that day, people will be able to renegotiate the loans. We have a lot of people who have a loan problem in Brazil, but to renegotiate the loans, you have to take the financial classes. And that is a project that we have with all the banks in Brazil. And we also have a project for education at schools. The level of financial education in Brazil is very, very low. It's even lower than the general level of education. And it's not very uncommon that I talk to people in some of the focus groups, and they are financing education with overdraft accounts, which is crazy. And some of the times you ask them, why are you doing this? And they don't have the financial education that's needed. So to conclude, we need to grow with inclusion. The project is all about reinventing ourselves with private initiatives, with private money. We want to remove the government from the scene more and more. We think we need to educate people financially so that they can plan their financial decisions in an optimal way. We want to foment entrepreneurship, diminish bureaucracy, diminish cost of credit, and I would finish saying that we are all about creating private solutions for public problems. Thank you.
Thank you very much, Roberto. I'll open the discussion to the floor. If I could just summarize briefly what has been said. I think it's been a very interesting set of presentations. It used to be thought that it was good enough to keep your own house in order if you're an emerging country. In other words, have the monetary and fiscal policy mix that preserves low inflation, and have financial regulations that preserve financial stability. And if you do that well, you will grow. It's no longer good enough to have your own house in order. the neighborhood counts now, and the neighborhood is a global neighborhood. And what Viratai and others were talking about was the importance of finding a new understanding amongst policymakers that can reduce the scale and volatility of spillovers from the advanced countries to the emerging. Because even if you have your own house in order, the volatility and scale of capital flows can reduce the policy space to keep having your house in order. And I think that's a very important insight and a very important part of the international agenda in the years ahead, not just in the spirit of cooperation, and Patrick's points are well taken, but also because it matters to global growth. It matters to growth everywhere. In the last 10 years, 2/3 of global growth has come from the emerging and developing world. And as Roberto mentions, that ratio will increase in the years to come. So we have to be concerned about getting capital to flow more reliably to the emerging world in search of real economic activities and in a way that can spur innovation and growth that helps not only the countries concerned, but the world as a whole. So I open the floor to questions. Yes, the gentleman there. If you can just very briefly mention who you are before you ask your question.
Sure. I'm a journalist. May I do a question?
Again?
I'm a journalist. May I do a question?
Yes, please, yes.
Okay.
Just say who you are, that's all.
Sure, sure. Ricardo Leopoldo, Agência Estado. To Governor Roberto Campos, how do you see after those days here in Washington, after meetings with investors and authorities, how do you see the prospects for capital flows to Brazil for the next couple of months? Thank you.
Thank you for the question. Well, I'm very optimistic. I think the message is start to go around in a more definite manner. I think people are seeing the efforts that Brazil are doing in this process of reinvent ourselves with private money. We are a liberal group that believes into markets, and I think more and more people are understanding where we are going. The fiscal was a big challenge, I think, passing the Social Security reform and putting a clear message that we are going to sell assets of the state and that we have a much lower cost paying interest rate because we have the lowest interest rate in our history. We will change the fiscal story, will give us room to grow in a more sustainable manner. So I think the message is starting to stick with investors. Unfortunately, we don't have a very favorable global scenario, but even with the global scenario and with the headwinds, I think we will start to see more and more flow to Brazil beginning from now on.
Next question. Yes.
Thank you very much, Paul Shea at Harvard Kennedy School. I was struck by listening to the presentations how much the content revolved around what you might think of as more structural or supply-side policies. So I'd just like to ask one or more of the panelists how you as a central banker coordinate your efforts in those areas with the other arms of government, because I'm assuming that with many of these structural supply-side issues, working with other parts of the government to achieve common aims would be rather effective. But how do you manage that process in a way that gives you still comfort as independent central bankers?
Good question. Who'd like to start? Patrick?
Sure. Thank you very much. It's important actually going forward. One of the points I should have said also is priority is strengthening the institutions, right? That is essential as well going forward domestically. And to your question about coordination, unfortunately, there is no, let's say, silver bullet to this one. And it is essential, we'll understand, we need to coordinate, particularly fiscal and monetary, but how you do that depends very much on the local circumstances. So in our case, there are three things that are essential. And this is particularly when you look at how growth, the prospects for growth. And I have generally argued that if you, in Kenya, to have what I would call a perfect storm, there are three things that needed to be done. One is fiscal consolidation. And in recent months, there has been a new effort to consolidate that. They have a plan, for instance, of reducing the deficit by 1.5% of GDP in this fiscal year, which is credible. I mean, it's fine to have plans, but are the plans credible? And we've looked at that. We are coordinating, therefore, on the monetary side, which will allow us space to be more accommodative if they actually can pull through on that. The second area, in terms of this, is a key structural measure was the removal of interest rate caps. The Parliament 3 years ago did put in interest rate caps, which we obviously opposed quite a bit. And these actually have led to significant dislocation of the SMEs. And I share a lot of the points that the governor from Thailand mentioned in terms of SMEs. So that actually, this week, the president has sent back a bill to Parliament and asked them to remove the interest rate caps. They have 14 days. Now maybe they have 10 days remaining to do this. And the point is that this is a key structural measure. Again, structural measures are not just generally, they are specific, and these are the two. Then the last one is the strengthening of SMEs. I mean, I could discuss this for years, I mean, for hours and so forth, but I think I just associate myself with all the comments that the governor mentioned a moment ago. These three measures, coordinated as we are doing, will, in our view, create a perfect storm, which will really raise not only global growth, but actually potential of the economy, which speaks to the point you mentioned. But again, the coordination needs to be done specific to the economy. Thank you.
Thank you. Virotai?
Thank you. I think these are great questions. We all talk about promoting structural reform policies, but making it happen is not easy at all. The way I see it, I would divide the world into two sets of issues, in the new world and the old world. For the old world issues, when you talk about structural reforms, there are always interest groups out there. It's very difficult for the government to embark on anything, and it's even more difficult for the central bank to be involved. But in the new landscape, the new world issues like digital landscape, I think that's, we don't see much conflict of interest out there. It's a win-win. There's a lot of possibility for win-win initiatives. In Thailand, we work very closely with the Ministry of Finance to improve the whole digital payment landscape, not only for the banks, but also for government agencies, for welfare payments. About 2 years ago, we launched the Faster Pay system, and it has been very well subscribed, using mobile phone number or citizen ID as a proxy for bank accounts. And now we have about 50 million accounts linked to our Faster Pay system out of our populations of 65 million. So all the tax rebates are now done through this Faster Pay systems, or the welfare payments are done through the Faster Pay system. So it has improved the welfare payments of the government in a big way, and the government can now do a much better targeted welfare programs with the platforms that we have put in place. So we have been looking for new areas where it could provide a win-win solution and use that as a catalyst to trigger down structural reform policies. The other thing that the central banks can play is to provide evidence-based thinking, evidence-based policy recommendation. The topic of our biggest annual conference this year, you would not think of it as a conference of the central bank. It's called Competitive Landscape in Thailand. So we look at using a big data analytics capability to analyze different sectors in the economy, trying to identify all the key issues related to competitiveness of the Thai economy, and provide evidence-based policy recommendations. By providing evidence-based policy, it's very important for the government to be able to direct their attention to priority issues and use that to basically convince the others that these are priority issues that we have to move forward. Just a short remark. What is more important is not coordinations with the government. I think it's a coordinations with the private stakeholders on structural reform policy. I particularly like the concluding statement that Roberto made, trying to find private solutions to public problems. Doing something like, faster pay system in Thailand, it created a lot of tension among the banks that were incumbent in this space. They were losing huge revenue every year. It used to be a cash cow income, fee-based income for the banks. But when we designed the system, we had to make sure it's an open architecture. We invited new players into the space. So the competition led to totally eliminations of electronic fund transfer fees in Thailand. But that's a big challenge. We had to make sure that we design proper market structure to ensure continuing competition that will lead to further innovations. Adopting technology is not technological questions alone. I think it's a microeconomic questions is even more important to ensure continuations of dynamic competition and development. Thank you.
Thank you. Roberto?
Yes, I'll be very brief. We divide, the answer is we divide all the measures in 3 groups. There is one group that we can do it at the central bank, which is basically banking regulation, and that's usually easier, and that we can advance very fast. There's a second group that we need a coordination with Ministry of Financing, and that takes a little bit longer sometimes, but it's working very well. We have been working very well. One example of that is everything that relates to capital markets. We have to have a vote in a group that also includes the Ministry of Finance. And then the third group is when it involves Central Bank, Ministry of Finance, and the Congress. And in Brazil, we have a system that everything that touches taxes and many other issues has to go to Congress. So we divide in 3 groups, and what we always do is we prioritize. And the prioritization is what can cause the biggest impact and what is easiest to approve. And so the way we have been doing the measures is prioritizing the biggest impact, and it's easier to approve.
Thank you. Any further questions? Someone right at the back.
Thank you very much. Puma Kimis with Alliance Bernstein and a member of the UN Task Force on Digital Financing. Governors, thank you for a very comprehensive overview of high growth markets. I prefer that over emerging markets, if I may. Given the developments and confluences that we're seeing between technology and finance, what do you think of the idea of regulation based on same risks and same rules? More of these companies that are fintech companies are beyond the jurisdiction of typical central banking regulation. So how do you foresee that? Same risks, same rules, or do we go by another measure? Thank you.
Who would like to start? Patrick?
Thank you. Good to see you here. Just for, I guess, for this full disclosure, I'm in the same UN Secretary General's Task Force on Digital Financing of the SDGs, so good to see you here. But in terms of regulating fintechs and all that, our experience in Kenya really has to be, let's say, assessed. But we have, because we have very much gone ahead where there were no, let's say, best practices, because there are no practices. When we moved ahead on M-Pesa and the other products that we have been working on, we couldn't look at other countries. We had to create the road ourselves, the path ourselves. But our approach has been and will remain, and at least until we see the underside of this, the soft side of it, is that we should regulate same risks in the same way. So it shouldn't be specific to the platform or the approach, but rather if indeed you're having, let's say, creating particular risk in the financial system, or even for that matter, dealing with customers in a particular way, the customer should also expect similar, should have identical expectations in terms of customer service and so forth. They're on this regardless of the platform. So that's the, let's say, equality, if you may, of the even-handedness of it. However, we do need to move. So it cannot be the banks, I mean, we are regulating them the way banks were regulated, say, 10 years ago, 20 years ago. After all, actually, the banks have moved. In our jurisdiction, the initial developments in fintech was actually by telcos, a particular telco. But actually, the banks got on the bandwagon, on the fintech bandwagon. And so they too have been very innovative, so they weren't left behind. So it is essential, in our view, to have similar risks dealt with in an even-handed way, and again, also moving how you're going to regulate those institutions. One of the key things I should insist on here is the speed of transmission of problems, let's say, has just rocketed. And this is a big issue if you're thinking of financial stability. In the past, you could think of waiting for a few days or even going to Congress. Or, I mean, that's the story, I think, of 10 years ago, 20 years ago, or even before that. Now, actually, things need to be dealt with within minutes. And I think that's the level of adjustment that we as regulators have to deal with, and in effect change how we deal with things so that we can deal with them quickly. Thank you.
Thank you. Virotai?
A brief response. In principle, I totally agree with the same risks, same rule approach. And in Thailand, we also modify our payment system act in a big way to make sure that we can adopt same risks and same rules approach across all operators of payment services. But putting it into practice is not that easy. We also want to incorporate the concepts of proportionate regulations to the risks. But it means that we have to use some judgment and putting it into enforcement. It will also involve other enforcement agencies when there is any wrongdoing against our regulations, our law. So the principles, I think, totally in full agreement, but putting it in practice, we need to do a lot more to make sure that we can enforce them properly.
Roberto?
Yes. Okay, so in the interaction that generates competitiveness, we like to divide this in 4 groups. The first one is reciprocity, which is who, since this is a business of data, who gives the data to who. So if a big tech company wants to access a bank to have payments for a client and wants to have the data of the client, they also have to give the data to the bank. So the first is reciprocity. The second one is cost sharing. As you start to have more and more interactions, obviously the big banks will have more inquiries than the smaller ones or the fintechs. So we need to understand how we are going to do the cost sharing properly. The third one is the rules for firewall, because different companies have different rules for firewalls, and you don't want to have a system that gets fragility in the middle. So you need to have a minimum standard so that they can interact. And the fourth is how you regulate them according to the activity, to the product, and to the risk. So at the end, I think it's same risk, same rules. We divide in these 4 groups. Thank you.
Thank you. I'm going to have to close the discussion, this first session. We've had 3 really excellent sets of comments. I think it's quite interesting that each of our 3 speakers spent a fair bit of time talking about the domestic plumbing of our financial systems, particularly what we need to do to improve the piping to strengthen inclusive finance, whether it's reducing credit spreads for small borrowers or enabling SMEs to manage FX risks, and more broadly, growing finance for the ordinary saver and borrower. It's, in all my experience at these seminars, this has been the richest discussion of these piping issues in our domestic systems, and that too is about how we keep our own house in order. I'd like to thank our 3 speakers for their comments, and we look forward to you succeeding in this very important mission. Thank you. now call the speakers for our second session to please join me on stage. And some of the people waiting in the wings, I hope you can find a seat. Well, ladies and gentlemen, if we could please get seated so we start our second session. Very good. We move now to our session on the advanced economies. We have framed the theme for this session very broadly. Essentially, we are talking about the future of macroeconomic policy. Not in the short term, we're not talking about today's policies of our central banks or fiscal authorities, but over the medium to long term, because we have entered a new environment of low for long, if you like, but also an environment where growth is increasingly a challenge everywhere in the advanced world. We have three very eminent members of the global policy-making community with us, and they'll be talking not just about their own countries, but also reflecting on the broader challenge faced by the advanced world. Governor Haruhiko Kuroda is, of course, well known to all of us. We have Klaas Knot, who is both the Dutch Central Bank President and also the Vice Chair of the Financial Stability Board. And we have Lawrence Summers, Charles W. Eliot Professor at Harvard University, and of course, former US Treasury Secretary and someone who's held very senior public positions over the last decades. I think we'll start with Governor Kuroda. We'll then go on to Governor Klaas Knot before coming to Larry.
Thank you. I would like to talk about monetary policy in a situation of low growth and low inflation. Since the global financial crisis, most advanced economies have experienced low growth and low inflation environments. Many central banks now face a common challenge of how to raise inflation rates. In Japan, the natural rate of interest declined significantly due to the bursting of the asset bubble and subsequent financial crisis in the 1990s. And the economy fell into what Professor Summers refers to as secular stagnation. Under such situation, the Bank of Japan has addressed the challenges of overcoming deflation for a long time. Today, I will present my views on monetary policy in a situation of low growth and low inflation based on Japan's experience by answering three questions. The first question is whether or not monetary policy is effective even during low growth and low inflation. My answer is that even in the face of a substantial decline in the natural rate of interest, it is still possible to stimulate economic activity and prices by strengthening monetary easing. The Bank of Japan has implemented various unconventional monetary policy measures even after the economy fell into deflation and short-term interest rates reached the zero lower bound in the late 1990s. The first approach is to influence longer-term interest rates through JGB purchases and forward guidance. The second is to lower risk premia of asset prices through purchases of risk assets. And the third is to influence people's inflation expectations through a strong commitment to achieving the price stability target, which is not considered as that unconventional. The bank's quantitative and qualitative monetary easing, which was introduced in 2013, includes all three elements. After its introduction, both short and long-term real interest rates fell to a level far below the natural rate of interest, and powerful easing effects have been exerted. As a result, Japan's economy has improved significantly, and for the first time in about 15 years, the economy is no longer in deflation in the sense of sustained declining in prices. Now that we are equipped with an unconventional policy toolkit, there is no need to be too pessimistic about the effectiveness of monetary policy. However, annual CPI inflation in Japan is still below the price stability target of 2%. It will take time to overcome an entrenched low inflation mindset, even with the powerful monetary easing. In addition, structural changes such as globalization and digitalization are constraining inflation worldwide. In order to achieve the price stability target under such circumstances, it is necessary to maintain upward pressure on the inflation rate for as long as possible and continue encouraging people to change their mindset and behavior. Regarding monetary policy conduct, the bank will persistently continue with powerful monetary easing. The second question is, what is necessary to continue with powerful monetary easing for a long time? Given Japan's experience, what is required in continuing with powerful monetary easing is to formulate and strengthen a highly sustainable policy framework, including countermeasures against the side effects. Since September 2016, the bank has placed yield curve control as the core of the monetary policy framework, aiming to control both short and long-term interest rates. The previous policy framework set quantity, that is, large-scale JGB purchases, as an operating target. This framework was simple to operate in practice and had significant effects on changing people's expectations. However, there was a problem that the degree of downward pressure of JGB purchases on the long-term yields could change to a large extent depending on economic and market conditions at that time. In contrast, under yield curve control, the bank set the specific target levels of interest rates and conduct JGB purchases to achieve that target. Therefore, yield curve control is a better framework in terms of exerting monetary easing effects in a stable manner over an extended period. In order to continue with monetary easing for a long time with a view to achieving the price stability target, it is also important to ensure stability in economic and financial conditions. In particular, close attention should be paid to the policy impact on the financial system. The bank adopts a multiple-tier system to current account balances held by financial institutions. This aims to prevent an excessive decrease in financial institutions' earnings stemming from the adoption of negative interest rates, which could weaken the functioning of financial intermediation. It is also necessary to pay attention to the shape of the yield curve so that concern over sustainability of pension and insurance funds will not increase through an excessive flattening of the yield curve. Needless to say, financial system stability should be addressed primarily through prudential policy. This approach is valid also in terms of the Tinbergen rule, that is, multiple policy objectives require an equal number of policy tools. That said, no prudence policy toolkit is perfect, and monetary policy influences broad areas of financial activities. Thus, the Bank of Japan should examine the monetary policy effects of financial functioning and make appropriate policy responses so that the cost of monetary easing will be reduced. Lastly, the third question is, under low inflation, should the relationship between the central bank and the government, in other words, the mechanical design of monetary policy, be reviewed in order to achieve the price stability target? It is not easy to answer this question, but let me present my views. First of all, it is important to ensure public confidence that central banks conduct monetary policy from a long-term perspective with the purpose of maintaining price stability under any economic situation. Expectation management is one of the most fundamental elements in conducting monetary policy. Central banks need to gain public confidence that they are fulfilling their mandate as an independent decision-making entity and have a strong commitment to achieving their goal. On this basis, they can successfully manage forward guidance, which is one of the important policy tools in a situation of low inflation. Central bank independence is not only intended to cut off inflation bias. However, under low inflation, the relationship between government and the central bank could become more complicated than before. In advanced economies, room for further monetary easing may have become limited. Indeed, as I mentioned, even under such circumstances, it is possible to stimulate economic activity and prices by strengthening monetary easing. That said, in responding to significant downward pressure on the economy, a policy mix of monetary easing, flexible fiscal policy, and economic structural reform for raising the natural rate of interest also could be an effective option. Moreover, the potential growth rate rises and the natural rate of interest increases. Together with the progress in fiscal policy and structural reforms by the government, the monetary easing effect could be enhanced. In Japan, the government and the Bank of Japan released a joint statement in January 2013 regarding policy cooperation. This statement clarified their stance to strengthen the cooperation in order to overcome deflation early and achieve sustainable economic growth with price stability. It also confirmed the following. First, the Bank of Japan will pursue monetary easing with the aim of achieving the price stability target of 2% at the earliest possible time. Second, the government will flexibly conduct macroeconomic policy and steadily push forward with structural reforms as well as initiatives toward establishing a sustainable fiscal structure. In this way, the government and the bank clarified their respective objectives and confirmed that they would cooperate while working within their respective autonomies. I think this framework is functioning pretty effectively. Today, I talked about monetary policy conduct in a low growth, low inflation environment based on Japan's experience. The challenges and issues of monetary policy conduct could vary depending on the time and economic environment. However, let me conclude my remarks by underlining that it is always important for central banks to conduct appropriate monetary policy in any situation in order to fulfill the mission of maintaining price stability. Thank you.
Thank you, Kuroda-san. We move on now to class.
Thank you, Tarman, and thank you also to your co-organizers for having me here in this panel. And a special O of gratitude I should give to the addition of the phrase "in the medium term" to the title of this panel, which allowed me as an ECB policymaker in the silent period to also join the discussion. So what I will do is, from a European perspective, I will focus a bit on some of the medium-term challenges that our economic and monetary union in Europe faces. And let me say in the beginning that thinking a little bit about this, that the medium term is actually quite an intriguing term. Because from a political perspective, the medium term is usually the place where one kicks the proverbial can to. But on the other hand, from a monetary policy perspective, if there is a medium-term challenge, it warrants an immediate policy response. And it's this asymmetry in policy reactions that might actually be at the core of some of the institutional frictions that we face in our economic and monetary union and that we have faced since the global financial crisis. Now, in order to elaborate on that, let me sort of take the first 20 years of economic and monetary union and divide it up in 2 decades. First decade, stable inflation, stable economic growth. Unfortunately, in the second decade, the union faced a continuum of economic challenges, the seeds of which had been sown already during the first decade of apparent stability. And this has brought important design flaws to the fore, design flaws that left the economic and monetary union prone to the buildup of macroeconomic and financial instabilities, and it also left it insufficiently resilient, I would say, to these shocks. The fact that now half of the economic and monetary union's existence has been defined by such challenges has also taken its toll on the public support for further European integration. But it's worthwhile noting that it hasn't taken its toll on the support of the euro itself. And although the clearest manifestation of this backlash is visible outside the economic and monetary union in the form of the Brexit, within the euro area there's also, let's say, the appetite for further far-reaching reform has also reached a sort of low point at this moment. And this is not surprising. If you look at sort of the speed with which sometimes quite contentious measures had to be implemented in response to the sovereign debt crisis, the various rounds of changes to the fiscal rules, the introduction of the European stability mechanism, they were all big steps towards economic and monetary union's integration, but in a quasi-semi-permanent mode of crisis management, often policymakers did not have much time to also involve their constituencies in making these changes. The magnitude of the euro area debt crisis was also amplified by the fact that the channels through which macroeconomic stabilization could take place were also insufficiently developed. And as a result, the adjustment burden almost exclusively was placed on monetary policy, where the interventions of the European Central Bank bought time to enhance the institutional framework and also bought time for individual member states to implement the much needed reforms. Now, the question, of course, now is, has this time been put to a sufficiently productive use? And I'm afraid that asking the question already boils down to answering the question, because the underlying economic performance clearly suggests that this is not the case. Since the start of the economic and monetary union, convergence appeared to be visible between the high and low per capita income member states. But when taking a closer look, however, we saw that real convergence before the crisis was mainly based on the activation of more production factors, and in particularly in terms of an inflow of external capital flows into the euro area periphery. Developments on total factor productivity, on the other hand, had an almost negligible impact on the convergence of real per capita income. And as we know from economic literature, productivity growth is actually indispensable for a sustainable GDP growth. It's the only sort of lasting source of sustainable increases in prosperity. But the inflow of foreign capital had mostly stimulated activity in the less productive, in the non-tradable sectors of the economy, such as, for instance, real estate. So when these macroeconomic imbalances then adjusted during the crisis, the real convergence that had seemed to be there was largely reversed. Now, after the crisis, we see some resumption of real convergence in parts of the euro area, but this time it mostly reflects a recovery in the labor markets, while the cross-border flow of capital have still stagnated, and there are still also very few signs of a more efficient allocation of production factors in our euro area. And this suggests that individual member states are still not reaping the full benefits of their participation in the economic and monetary union. And it also may again leave our economies vulnerable to shocks. So in this light, the recent slowdown that we've seen in the euro area activity, albeit largely caused by external trade shocks, but it is also a firm reminder that a further strengthening of the foundations of our economic and monetary union remains necessary. Without additional action, I'm afraid that once more monetary policy will risk ending up as the only, perhaps somewhat stuttering engine supporting growth, and then by and large pampering over the structural challenges. And that is, I think, not a desirable situation. I hope we would all agree on that. And against that backdrop, allow me then to make three relatively straightforward, not always very new, but nonetheless worthwhile to repeat recommendations, which I believe should be prioritized. First, private risk sharing between member states should be strengthened. And that involves concretely the completion of the banking union by means of having a European deposit insurance scheme. It means by creating a European capital markets union so that we can better diversify our sources of investment funding. And if we sort of succeed in this area, the contribution of these initiatives can be multifaceted, I would say. We know from successful other monetary unions that private risk sharing bears the brunt of any adjustment to asymmetric shocks. It thereby also relieves a lot of the burden on public sector stabilization policies. It has the potential to foster more efficient and sustainable cross-border financing flows that will then support potential growth throughout the euro area, and that will then also contain the risk of future imbalances. My second recommendation, and that has also increasingly coming to the fore, and you heard a lot about this also in the last few days here in Washington, is that it would be quite beneficial if future monetary and fiscal policy would, more in the past, move in the same direction. There is mounting evidence that monetary policy can reach its goals faster and with fewer side effects if it is aligned with fiscal policy. And that's definitely true, I would say, in a sort of liquidity trap type situation as we now seem to have arrived in. The combination of a unidirectional fiscal and monetary policy reaction to changes in economic conditions can create an environment where both public and private investment can bolster economic recovery and support the growth potential of our economies. My third recommendation starts from the observation that, at least in the current juncture, the economic monetary union's design remains a compromise between limited risk sharing on the one hand, and therefore a large degree of individual control and hence accountability on the other hand. But that implies that member states continue to also be subject to market discipline, and it also places a distinct responsibility on the shoulders of these member states to also individually create the preconditions that would enable their economies to flourish within the framework of the economic and monetary union. Now, judging by various measures of ease of doing business, strength of the legal system, it becomes clear that structural and institutional reforms remain very, very necessary to stimulate potential growth. So in short, I would say it's all about addressing institutional imperfections within the economic and monetary union. It's about improving the consistency between fiscal and monetary policies, and it is about kickstarting structural economic reforms in member states to increase our growth potential. When aggregate demand is no longer as big a problem as it was a few years ago, we should probably focus more on lifting our growth potential. Now, notwithstanding the political intricacies of these issues, they can of course only be solved by a credible commitment from all policymakers involved. And that's the kind of commitment that would enable the economic and monetary union to start reaping the potential benefits today from solving the issues that we know we will otherwise be facing tomorrow. Or in terms of the proverbial can, picking it up today will save us cleaning up an undoubtedly bigger clutter in the future while living in a tidier place in the meantime. And on that positive note, I would like to conclude.
Thank you very much, Klaas. It was a positive note. Larry.
Thank you very much. The job of policymakers is to be sound in what they say. The job of academics is to provoke in what they say. I am today an academic, so here goes. I put forward secular stagnation as a hypothesis in 2013. I think that was the right view in 2013. Today, I think it is a presumption. Why do I say that? Relative to what the world thought in 2013, budget deficits in the industrial world have been substantially larger. Interest rates have been substantially lower. Credit growth has been substantially more rapid. And asset price inflation and leverage have increased substantially more than was expected. And yet, with all of that, growth has been substantially slower than was predicted, and crucially, inflation has been substantially lower than we expected. When you have low quantity, surprisingly, and low price, something has happened on the demand side. When everything has been done to push accelerators to the floor, and even with that, growth is slow, you have an even larger presumption of a problem on the demand side. To put the point in a different way, a substantial part of the industrialized world, and I'm going to focus only on the industrialized world in this presentation, is in what one might call a black hole liquidity trap. Zero interest rates and market judgments that we're not going to leave them anytime in the foreseeable future. The remainder of the industrialized world is one recession away from black hole liquidity trap economics. No one can doubt that when the next recession happens in the United States, interest rates will fall back to the lower bound, and experience suggests that once they're at the lower bound, it's very hard to get off of that point. That's why I think secular stagnation is so important and should force substantial changes in our thinking. I would pose the issue this way, and this is consistent with the way I've talked about it in the past, but not precisely the same. Oops. Somebody help?
Yeah. I'm not the one to help on this, but Stuart, do you know how to handle this? Does someone know how to handle it?
I'm sorry.
No, you figure it out.
There we go. See, I knew that Singapore has a tradition of technical expertise, and I have a tradition of incompetence. Here's the central problem. The private saving generated by the world is not absorbed by the private investment generated by the world at comfortable interest rates and with comfortable financial conditions. The lower line for the OECD shows the gap between private sector savings and private sector investment. More consequentially, the upper line shows what that gap would be if interest rates had not been trending downwards and in the process discouraging saving and increasing investment. And what you see is that the no policy, no change in the world gap quite likely could be as large as 10% in the current world. That reality, that savings are not comfortably being absorbed by private investment demand, I would suggest drives much of what else is going on. First, it obviously drives very substantial declines in real interest rates and estimates of neutral real interest rates. These are five-year estimates of the real interest rate. What you can see is that for the industrial world averaged, they're now substantially negative, about 75 basis points negative. This, I believe, is what has created an environment in which a substantial part of that savings investment gap has been absorbed by increased government budget deficits and increasingly generous entitlement programs over a long time period. Lucas Rachel and I made the point that the so-called natural or neutral interest rate is not some constant of nature, but is shaped by policy, and asked the question, if we had not absorbed private savings by running larger budget deficits in the industrial world, if we had not reduced the propensity to private save by providing increasingly generous social insurance, what would have happened to the neutral interest rate? Now, obviously, any calculation of this kind depends on a lot of assumptions, and I certainly am not going to live or die on our numbers. But our numbers suggest that the effect of public policy has been to raise neutral real interest rates by about 4% higher than they otherwise would have been. So that what we see, which is a 2 or 3% decline in what we perceive as neutral real interest rates, is the net of natural economic forces, which would have driven them down by 6 or 7 percentage points, and larger budget deficits, more social insurance, which would have pushed them up substantially. So, in a sense, fiscal questions are being driven by this problem. To put it a different way, if interest rates weren't so low, budget deficits surely would not be so big. There are further consequences. In a world where savings are not being fully absorbed, demand is short. When demand is short, growth is sluggish, and inflation is difficult to increase to target. In a world where demand is short, the incentive to capture it yourself is strong. If you can't simply increase demand by lowering interest rates in the normal way, the tendency to protection is enhanced, the tendency to devaluation and currency war and expenditure switching is enhanced. In a world of high savings and a world of limited investment opportunity, and by the way, the reason investment opportunity is limited is in part a manifestation of a good thing, which is that capital goods are so cheap. Savings flow into existing assets, bidding them up, and so you see substantial credit growth to purchase existing assets, asset price inflation, increased leverage, and enhanced multiples. And finally, you see the fortunate see their asset prices go way up, and those looking to join the system, panicked about their ability to save and earn a reasonable return to prepare for their retirement, and finding any assets that they wish to purchase to be inordinately expensive. So I would suggest that this all drives a substantial part of what we see. What is to be done? I am in favor of central bank ingenuity, but am convinced that monetary policy has hit very substantial diminishing returns in terms of the marginal impact of either interest rate reductions or quantitative easing, forward guidance type measures. In past recessions in the United States, interest rates have been reduced by 500 basis points. If the U.S. gets back to 25 basis point Fed funds rate in the next recession, if nobody does anything else, the 10-year will be below 1%, and so the incremental scope for measures beyond the 175 basis points remaining for central banks will be extremely limited. What's to be done? First, just as we recognized that the central problem after the 1970s inflation was establishing frameworks that addressed the dynamic consistency problem and maintained discipline with respect to inflation, the central organizing problem of macroeconomic policy needs to be the absorption of private saving in ways that are consistent with sound economic performance. I do not believe these issues can be addressed simply by spurring productivity growth, good as that is. Higher productivity growth is likely, in a sense, to exacerbate the problem in the medium run of a savings investment gap, because it's likely to lead to increased saving in the short run, as it consistently has in Asia, and put downwards pressure on interest rates. Academics' Euler equation models notwithstanding, Alan Greenspan was right when he diagnosed higher productivity growth in the United States in the mid-90s, and right when he concluded that the right lesson was that interest rates needed to be lower in response to that discovery because of the reduced inflationary pressure. How best to absorb the private saving? Very quickly. First, reducing gratuitous policy uncertainty both discourages saving and promotes investment. Normally, perhaps extra uncertainty can be dealt with simply by allowing interest rates to fall, not in today's world. We had a term at the Treasury when I was there, iatrogenic volatility. Iatrogenic illness is when you go into a hospital and get sick. Iatrogenic volatility is when policymakers talk or tweet and markets become volatile. It's important that we try to avoid it. The case for finding mechanisms to substantially increase infrastructure investment is compelling, and I will not repeat it here. Whatever the right principle was when the Maastricht Treaty was conceived, and people believed that normal real interest rates were 2.5%, the right fiscal principles have to be different today in a world where markets are expecting and governments are able to lock in negative real rates over very substantial horizons. We need a new theory of fiscal sustainability. The Greens are right, and they are an example of a broader principle. There is no fundamental shortage in today's world of attractive investment opportunities. There is a shortage of attractive investment opportunities that are profitable with standard business models in the current environment. And finding ways to make socially attractive investments that do not, with current business models, prove profitable is, I believe, a central challenge for governments going forward, none more important than in the environmental area. For example, if the United States were to accelerate the elimination of coal-fired power plants through regulation, the result would be an increase in the level of investment. Enhanced social insurance reduces the need for private saving and enables increased consumer spending. This is probably the right time to be thinking about increasing Social Security when retirement is going to be much more difficult because of low returns on private saving, rather than the fetish that has existed for years in the United States around curbing entitlements. Note that increased pay-as-you-go Social Security does not change budget deficits, does not increase the level of government debt, but does increase the level of spending in an economy by reducing the need for individuals to put aside their own resources for retirement. And of course, an observer from Mars would find it very odd that in a world where the workforce of the rich industrial world is shrinking, that there are no net capital flows from the rich countries in aggregate to the poor countries. Britain had exactly the problem I am describing in the late 19th century. It solved it by running a 10% of GDP current account surplus for 3 decades so as to maintain substantial aggregate demand, and in the process exported capital. Now, no one is recommending a return to empire, but the increased demand that could be generated through more effective international financial intermediation, and probably to an even greater extent, finding institutional solutions that make investment in the developing world more profitable, would also address this challenge of absorbing all the saving. If we do not find solutions, we will oscillate between, as we have and I believe will in prospect, we will oscillate between periods of very sluggish growth and sub-target inflation, and periods of adequate growth and reasonable inflation that will rest on foundations of either unsustainable fiscal policy or unsustainable leverage, asset price inflation, and private sector credit growth. Read this week's IMF Global Financial Stability Report, and it is hard to escape the view that their judgment is that whatever is good, and it's not that much in the current environment, rests on a foundation of unsustainable finance that is setting the stage for the next crisis. We need to recognize secular stagnation, and focus on the problem of assuring adequate savings absorption. Thank you.
Thank you very much. So I now open the floor to discussion. Roger, if you could just...
Thank you, Roger Ferguson, TIA, and trustee of the Group of 30. Thanks to all three for great presentations. 1996, 1995, I gave a speech during an investment shortfall problem. Other voices were talking about savings glut. Larry brought the two of them together intelligently. As I thought about it and think about it, hearing Larry's discussion, one of the ironies, if we actually do improve investment the way you're talking about, is it will over time increase productivity. That's not a negative thing, it's a positive thing for society overall, but it would have some of the, maybe, I'll use the word perverse, impacts on interest rates. So how do we, I think we should all be in favor of increased productivity, recognize what it does to investments, to interest rates going forward. So Larry, any comment on that would be helpful.
Be clear, I am in favor of anybody's good idea for accelerating productivity growth anywhere. And I am very sympathetic to the view that there is substantial low-hanging fruit with respect to doing that. What is a mistake, in my view, is to suppose that if we did that, everybody would feel so optimistic that they would then spend more and invest more, and that this problem would go away. Instead, if we increased supply, the problem of assuring adequate demand with the sound foundation would be enhanced. And so the need for some set of choices and actions among the measures that I just laid out would be increased, not decreased. Look, it's to be slightly a wise guy, central bankers always think that the problem is we need to do something about structural rigidities. And I would politely suggest that anybody who had the same structural solution for excess inflation at some point in the past that they now have for the inability to achieve the 2% inflation target in the present should think about whether it's really very likely that too much inflation and too little inflation have the same, call for the same policy response. So yes to productivity growth, but do not think that it will raise the neutral rate on its own, and therefore the problem with virtually every model that's used in a central bank is because it contains these Euler equations and stuff, it creates the impression that it is slow growth that is the cause of low neutral rates. And therefore that if you can increase productivity growth, you can solve the set of problems around low neutral rates. And I believe that's an unlikely, not inconceivable, but unlikely proposition.
Yes. And if any of the others want to respond to that last question as well.
Thank you. Danai Kirakopoulou from OMFIF. I wanted to pick up on a suggestion made by Governor Virata in the first panel that we should not just be thinking about an interest rate zero lower bound, but also start thinking a little bit more about a financial stability lower bound, and ask what the panel thinks of this, and also where you think we are in relation to this suggested lower bound for financial stability in the respective jurisdictions of Japan, the Euro area, and the United States. Thank you.
Good, thank you. Klaus and then Kuroda-san.
First of all, I would say that most of the financial stability issues that we're seeing in the current context are global in nature, so I don't think there is a need to sort of decompose it in the various geographical regions. But I think with Larry, actually, that the Global Financial Stability Report that I closely read coming into it is actually an excellent piece of work. And I think it contains a lot of leads that suggest that actually we are also approaching that, that lower bound, particularly if you look, for instance, in the area of corporate indebtedness. And that is increasingly a global a market where leveraged loans, even if they are created by US companies, are now sort of have found their way all through the financial system, leave their marks on, for instance, Taiwanese life insurers. There's a chart on that in the GSFR, just to pick an example of the sort of the international spreading out of these kinds of risks. And I think, well, as I said, I think this is increasingly an issue, and it is a global issue. It's not confined to one or two jurisdictions.
Yes, actually, Japan has experienced so-called low for long or low for longer situation in the last nearly 20 years. Interest rates have been quite low in the last 20 years. And as I said, we embarked on a new monetary easing program in 2013. And since then, real interest rates declined quite significantly, and so on and so forth. So that naturally, the Bank of Japan has been carefully monitoring the financial sector stability issue. And twice a year, Bank of Japan issue financial sector analysis in great detail. And of course, if low interest rate situation, monetary easing conditions continue, there could be two kinds of risks in that situation. One of them is financial excess. Some financial institutions, investors, and so on and so forth, making search for yield and so on and so forth, and then some financial assets may be excessively priced, and at one stage those bubble burst and so on and so forth. So this kind of financial excess we have been carefully watching, and so far we haven't found any serious financial excess in the Japanese economy. Another kind of risk is what we call disintermediation, or this functioning of financial intermediation. Here again, despite some negative impact on the profitability of the banking system, so far the Japanese banking system continue to expand their loans by 2 to 3% every year, and at this stage there's no sign of disintermediation starting. However, certainly the fundamental source of profit of particularly local banks, regional banks, interest rate spreads, and spreads have declined, and if this situation continues and even further decline, then that could have a significant impact on the banking sector, particularly local banks and regional banks. And we have been making various stress tests and so on and so forth. And at this moment, it's not a serious problem, but in 5 years, 10 years' time, could be a serious problem, so that we have to always carefully assess the balance between the effectiveness of monetary policy, I think, which is still quite clear, but on the other hand, cumulative negative side effect in the banking sector, we have to be carefully analyzing, and always, as I said, if we further intensify monetary easing, we have to take care of the negative impact by some ameliorating measures.
Thank you. Larry?
I thought what Kuroda-san said just now seemed very, very thoughtful to me. I remember, though, in about 2002 or 2003, Alan Greenspan said at the FOMC that we're reducing rates to 75 basis points, and it's the right thing to do because we've got a slowdown and a problem of spurring growth, and we've got a risk of tipping into disinflation or deflation. But there will be deformations and distortions and problems that will come from having done this. He was right. And I think that while John Taylor and I disagree about most aspects of the things we're discussing. I think John Taylor is right when he suggests that the fact that we had really easy money in the period before the financial crisis was an important contributor to the various developments that led to the financial crisis. I think he's not right, or I don't agree with him, in sort of not quite seeing what the alternative was. And if we had had his preferred monetary policies, we would have not gotten to full employment and had sluggish growth and had a set of problems of that kind. So I think the lesson is not just if you run tight money all the time, all will be good. It's that you need to find sources of stimulus other than easy money. And I might just use the moment to comment that I am always inclined to reach for my wallet when I hear anything about countercyclical macroprudential policy. I'm reminded that Spain was the hero of that before the European crisis in 2008. And I ask myself right now, if I was in charge of macro-pru counter-cyclical stuff in the United States right now, or in Europe right now, would I be supposed to read the IMF report and go, oh, we better be building up capital reserves and we better be doing all of that stuff, like from the Global Financial Stability Report? Or would I be supposed to read the World Economic Outlook and hear that recession risks are substantially greater than any time they've been in the last 10 years, and think that I ought to be doing everything that I can to facilitate a strong flow of credit? And I don't know what the right answer to that is, but I think to believe that we're going to manage this all by having terrific countercyclical prudential policies is to place more faith in the omniscience and forecasting ability of central bankers than would be warranted on the basis of a reading of history.
Thank you, Larry. Klaus.
Well, this is a very nice lead into the additional point that I also wanted to make. I can't make it so eloquently, but nonetheless, there is a bit of an illusion to think that we can sort of stem these risks because we have developed all kinds of macroprudential tools. But we should never forget that first, macroprudential tools have a very limited scope of application. So the longer they are in place, the financial sector will find ways to move around them. Secondly, in the area of corporate debt, I don't know what macroprudential tools we're actually talking about. We have macroprudential tools when it comes to mortgage financing, housing markets, and the like. But if you read the GSFR about the corporate stuff, there is no macroprudential measure there, and we should actually, over time, think about tax deductibility, etc., of corporate debt. But before we sort of start thinking that and putting a project in train and have the results of that, I mean, this is a decade-long project that is not going to be relevant for today's problems. So in that sense, that should also be part of the conversation on the financial stability lower bound, that we shouldn't have the illusion that if monetary policy and macroprudential policy are moving in opposite directions, that macro-pru can then contain the effects of monetary policy.
Well put, thank you. Could someone bring the microphone to the second row in front here? You can sit down.
There is a widespread recognition of a climate emergency. If the governments of the world manage to mobilize the necessary resources to combat it, won't it reverse the secular stagnation?
Thank you.
George, that listed green investment as an important part of the policy solution. look, when people talk about secular stagnation, they go back, as I did originally, to Alvin Hansen. And then some people say, well, look, he was wrong. He said there was going to be secular stagnation, and there wasn't afterwards. Other people, I think probably the better judges of the situation, say, well, there was World War II, and if you believe the secular stagnation theory, you would believe that some event like World War II that required very substantial public investment and called for very substantial public investment would be exactly what you would do to solve the problem. And so I think you're right that to the extent that it was the right thing, and I share your broad views about climate change, to invest on a very substantial scale in reducing climate change, a world that decided that it wanted to devote 2% of OECD GDP to necessary green investments to contain climate change would be a world that would see these kinds of concerns fade away quite quickly. I think one needs to recognize that a substantial part of the green investments that are necessary won't just happen spontaneously by saying that this is a problem and companies should invest more. It will happen because policy frameworks are in place that either mandate the investments, make the investments, or incentivize the investments. But I don't think as yet, it'd be an interesting calculation to do, I would be surprised if you could make a case that all the global warming policies that have yet been put in place have generated an extra 0.3% of industrial world GDP in extra investment. But yes, absolutely, if we did it at scale, it would address this problem in a very important way. Yes, and in that sense, the term Green New Deal seems to be a resonant one. I think it's unfortunate that the advocates of the Green New Deal have chosen to make it an umbrella for every progressive issue that they feel strongly about. And it would be better if the term Green New Deal and the energy around recovering from stagnation while doing things that are important that it connotes was focused much more narrowly on the climate change problem.
Kuroda. Thank you. You may know I was president of the Asian Development Bank from 2005 through 2013. And during that time, ADB was fortunate enough to increase the capital basis by 200%. And naturally, ADB increased very much sort of green investment, renewable energy and energy-saving plant and equipment, infrastructure in Asia substantially. And under current President Nakao, ADB also combined general capital with ADF, Asian Development Fund, so as to substantially increase green investment in Asia. And also ADB has issued sort of green bond with very good terms and conditions. Of course, this is just to increase green investment, green infrastructure in Asian developing countries. But the issuance of green bond purchased by Japanese investors and so on and so forth must have facilitated green investment in Asia. So I think the private financiers in the US, Europe, and Japan could facilitate green investment in developing countries, as well as, of course, developed countries as well.
Yeah, I just want to say that I wholeheartedly agree to what has already been said on this Green Deal. The energy transition primarily, I think, is an issue of private investment, but since there is the time consistency problem with any public policy that sort of needs to be consistent on a time horizon which exceeds the political, let's say, 4 to 5 year cycle, I do think that there needs to be also public investment as a sort of commitment device to unleash private investment in this area. And I would say a second element, by the way, as part of this Green Deal, energy costs will have to go up. I mean, we will have to have carbon taxes, so particularly the cost of fossil fuel, we will have to start internalizing the externalities. So even from the mandate of us humble central bankers, at least in the short run, well, not the short run, but at least in the foreseeable future, that should also be inflationary rather than disinflationary.
I'm going to take a final round of questions, but you'll have to keep it extremely short because we're running out of time. First, Nakao-san.
Of ADB, and Professor Sama said we should enhance social insurance. But if we do that by the government saving, it tends to increase the saving of public sector. And if we do it in the pay-as-you-go way, it would overburden the production age population, which is already overburdened, which might have a negative incentive for the consumption or working. So is that really a solution? Yeah.
We'll take the other questions at the same time, the gentleman here, and then one at the back, and that's it.
Thank you, Thurman. Peter Yeoman. I have a question to Governor Knott. The three governors of the first panel from the so-called emerging market countries were speaking about the need of innovation, technology change, entrepreneurship, SMEs, and so on, in order to create economic dynamism. Wouldn't this be a good advice for the so-called advanced countries in Europe, and in particular within the Eurozone?
Is it on? Yeah. Arminder Benkian, Central Bank of Armenia. My question is to Professor Summers. So in the world where the productivity growth actually generates deficient demand, do you think that the failure of the central bankers to stimulate demand actually decreases the natural interest rates further? Because central bankers usually think supply side and demand side are separate. And the related question, I think you're saying that if you put aside the government policies, the natural interest rate decline would be around 7 percentage points due to natural forces. So what are these natural forces that, despite the productivity growth, actually push the natural interest rates down?
Well, if I could just pose the question that Nakao-san made in a broader fashion. If we accept Larry's point that the central organizing issue for macroeconomic policy is how we can raise investments so as to absorb savings. There are two ways of raising investments. One is to stimulate private investment. The other is to stimulate or grow public investment, even if it means running deficits. If our ultimate aim is to raise economic growth and lift the natural rate of interest, we'll have to think through fiscal policy, bearing in mind that we need to do some things for the medium term, possibly for a very significant period of time, but ultimately you do want to end up in a situation where the rate of interest goes up. So what are the things that you do to shift fiscal policy? The things which Larry has laid out and which both Kuroda and Klaas have spoken about involve some very large requirements. Green finance is probably the largest in terms of its needs, the need for investments in sustainable infrastructure and innovation. North-south capital flows, as Larry calls it, or basically having a reliable flow of capital to the emerging world so as to grow the global economy, is probably next in size, and is also going to be with us for a very long time. Infrastructure renewal in the advanced countries is significant, but not necessarily the largest longer-term challenge, but a very significant short to medium-term challenge. And then you've got social insurance. So Nakao's point is, should social insurance better be funded out of current revenues as part of a longer-term dispensation that has to be decided politically within countries, and concentrate on the investment in public goods, global and national public goods, as a way of lifting investment rates, public and private investment rates?
So I guess my view is that the world might overreact to this problem. And I think it's true that if there was going to be a sufficiently large spurring of green investment, spurring of infrastructure investment, mobilization, I think the problems with flows of capital to the emerging markets have more to do with the environments in those markets and whether the capital will earn a good return than they do with the supply side in the industrial world. If I thought the world was going to mobilize itself on a sufficiently large scale, I probably would not be in favor of using up scarce fiscal space on pay-as-you-go social insurance. It seems to me, though, that the risks, it's a little bit like, should I lose 30 pounds or should I lose 60? It doesn't seem like it's the current most important issue. And so I'm inclined to think that any of these sets of measures that would operate in the direction of promoting demand and raising neutral rates would be desirable, at least as a way of moving forward. And if at some point in the future people decided they wanted to take the pay-as-you-go system and shift it to a more contributory basis, that would be a decision that they could make. I think the really important thing to understand, though, is that the trend downwards in neutral real rates, which is driven by some combination of demography, changing income distribution, generalized technological trends that involve the demassification of the economy, and falling capital goods prices, that trend has been a much stronger trend than we've perceived, because a lot of it has been offset by changes in fiscal policy of a kind that we're not likely to be able to repeat in the future. That's why I'm inclined to be in favor of almost all measures that point in the right direction.
Thank you. 3 points. First, actually, the Bank of Japan maintains so-called funding for lending scheme, under which the Bank of Japan provides extremely concessional loans to commercial banks, which finance innovative investment, R&D, and so on and so forth. So indirectly, our funding for lending scheme provides some incentive for innovation. Second, green investment. As I said, public sector green investment would become even more important, but at the same time, as I said, the private sector, financiers as well as investors are extremely interested in green bond and other financing mechanisms of green infrastructure and green investment. Third, as Mr. Nakao mentioned, the Japanese pension system is also largely pay-as-you-go system. And since the Japanese population is rapidly aging, to increase pension benefit at this stage could undermine current working age population as well as future working age population consumption. So that I think probably in the Japanese context, we have to be cautious.
Thank you. Final word from Klaus.
Yeah, thank you. I completely agree that what was said in the context of emerging market and development economies about the need to move public policy more in the direction to foster innovation, dynamism, a culture where sort of more startup businesses are being created, etc. That is equally true to many of the advanced member states in Europe. If you look at ease of doing business indicators, if you look at global competitiveness indicators by the World Economic Forum, there is a wide disparity among advanced European countries, and there is a lot of, I think, potential for best practices, catch up, etc. Also, if you look at the composition of fiscal spending that we haven't talked much about, but I think over the last few decades, fiscal spending has moved away from public investment in the direction of social security spending. That's a fortiori true for Europe, which by far delivers the bulk of social welfare, public social welfare spending, even from a global perspective. So yes, this is absolutely true. One point to Larry, I mean, I agree that if you foster productivity growth, then obviously mechanically you increase supply, and if there is a gap between demand and supply in the beginning, the gap is higher. But I would say there is one caveat. To the extent that spending is withheld because of concerns about debt sustainability and sort of balance sheet type restrictions, then of course productivity growth would also help to alleviate the real sort of debt burdens and could therefore also unleash some positive effects on aggregate demand.
Just as a matter of economic theory, you're entirely right that productivity growth, in anticipation of an increase in productivity growth, there are a variety of mechanisms through which it would increase demand. In the academic models used in central banks, those mechanisms are very, very strong. In my judgment and in my reading of the experience with countries that see substantial accelerating in productivity growth, it ends up being on net deflationary because the supply effect exceeds the demand effect. And so one can't hold it out as a solution to the concerns that I'm expressing. But you're entirely correct in what you're saying. Indeed, in the academic models, if I announce today that productivity growth is increasing from this moment forward, then there hasn't yet, in the 2 months from now, there's been no change in the level of supply, but people feel more optimistic about the future and they spend more and all of that, and so it creates excess demand. In practice, that is not what we observe, or at least that's my reading of the empirical evidence.
Thank you. Well, I'd like to thank all three speakers for an excellent discussion. Thank you.
Thank you, Tarma.
It's good to see you. Enjoyed it. Okay, thanks. Enjoyed it.
If I could call the speakers for the last panel on stage. Very good. We'll start our third session now. I'm not sure if it is titled quite the right way. It's currently called Cryptocurrencies in the Future, but what we really had in mind was to have a discussion on some of the emerging ideas around digital currencies or global stable coins, if you like, private or public. It's a very important and evolving theme in global discussions. both amongst central banks and financial regulators and amongst private sector participants. And I think we're not yet in a position where we know what the optimal solutions are. And I say solutions with a plural rather than in the singular. But we have with us three speakers who are each looking at this very closely. David Marcus, of course, is head of Calibra and has been one of the people who's been exploring and advancing the ideas behind Libra. Augustine Carstens, of course, well known to everyone here, currently as General Manager of the BIS, but with an exceptional record in public office in Mexico. And Daryl Duffy, who's a well-known academic, finance and economics at Stanford. Des, I'm not sure if it's your day job or your night job, but you're looking at digital currencies very closely as well. I think what we'll do is we'll start with David Marcus, we'll then move on to Daryl, and we'll come to Augustine. David.
Thank you, Tharman. Thank you to the Group of 30 for inviting me to this event. It's truly an honor to speak with this audience and share our progress with Libra more openly. First, I'd like to spend a bit of time highlighting the motivation behind Libra. This is something that has become extremely personal to me over the years. And we've seen that the internet has changed the world in such a profound way and has democratized access to free unlimited communications, the world's knowledge, and facilitated a more competitive market, resulting in lower prices and lower barriers of access for billions of people around the world armed with a $30 smartphone. The same isn't true today in the financial world. What is more, while pre-internet communications were expensive, they were at least priced the same way for everyone. The current system penalizes those who can afford it the least, and while there has been great innovation and progress on the edges of our current financial system, its core has not seen much progress in over 50 years. The result? 1.7 billion people are still unbanked, while 1 billion of them have mobile phones. Cross-border payments, a $700 billion annual market, still costs 7% on average, and costs have stopped coming down. There is no global protocol for a payment tool allowing for interoperability for wallets and banks. It's a bit as if you still couldn't exchange emails between Gmail and Yahoo Mail. Small business owners are stuck with their local or national markets in many cases and can't access the global economy as easily and cost-effectively as they should. It's about time for a change. Second, I want to reiterate our strong commitment to complying with applicable regulatory requirements before the Libra blockchain goes live. We recognize that a change of this magnitude can't be operated without a great sense of responsibility. We don't shy away from regulation. We seek to comply with it and embrace it. This week, the G7 Working Group's report on global stablecoins highlights a framework within which we believe Libra can operate. A new global protocol for payments must be designed and operated in such a way that it not only augments good monetary policy, but also advances the efficacy of current standards for consumer protection, AML, CFT, and criminal activity detection. This is our commitment as we build this network, and we're hard at work to ensure our actions and our work reflects this commitment. As an example, we're fully supportive of a licensing regime that would prevent the Libra Association from changing the backing of the reserve into a fractional reserve system. We're also working with the Libra Association and their other members to design controls throughout the Libra network so that we are able to appropriately address AML sanctions requirements and build a safe ecosystem. A proposal is currently being discussed with key association stakeholders that would address compliance across the whole ecosystem. Third, it's also been very clear to us from the very beginning that a payment network such as the Libra network shouldn't be controlled by one company. We welcome competition to benefit local access and strive for the lowest costs possible for consumers. This is why, despite Facebook's large investment into the development of the required technology to launch such a network, all the code is now open sourced. This is also why Facebook has relinquished its control, and now, since the beginning of this week, is only one equal voice alongside 20 other initial members of the Libra Association, and in the future, many more to come. Fourth, privacy is essential when it comes to money and transactions. This is why Facebook created Calibra Inc. as a separate subsidiary to ensure full separation of financial and social data, something people have told us loud and clear that they wanted. Fifth, we really believe in the opportunity of a broader public-private partnership to make Libra even more successful and trusted. There's a spectrum of engagement available for us to work together. We also understand that the appetite of the public sector might evolve over time, and it's our desire to ensure we can accommodate this as Libra gains traction, as we answer legitimate concerns that have been raised. Sixth, last but not least, I'd like to stress with this esteemed audience that the status quo is not an option any longer. Multiple digital currency projects are being actively worked on as I deliver this speech. Some will launch this year, some next. The train is leaving the station. Together, we can make sure the right kind of train arrives at the destination. One where people all around the world have much broader access to digital money and financial services. One that lowers costs for moving money around the world for everyone. One that enables more trade across borders, and one that doesn't sacrifice security, privacy, and our ideals in the process. So please join us on this journey. We can work together towards a better future for the people we all have a responsibility to serve better. Thank you.
Thank you very much, David. Darryl?
Thank you, Tharman. It's a great opportunity. This is very timely. As we heard on the first panel this morning, the time is ripe to upgrade our payment system, and there are a lot of opportunities that are not being met currently. And I agree with the key points, actually, all of the key points that David has just brought up, namely that there's a vacuum that needs to be filled with a better payment system, and also that the use case for Libra and other digital currency entrants, for example, through stablecoins, is well established, and that it's feasible to do exactly what he described. And yet, at the end of my remarks, I'm going to recommend a different solution. So just briefly to set this up, operationally, what Libra and other digital currency stablecoin entrants are promoting is the idea that when Alice goes to the bakery to buy a loaf of bread, she will hand over a token. Currently, it's paper money, and in the future, it could be a stablecoin. The alternative, which is the legacy system that we have, is to make a payment. Alice will instruct her bank by one means or another to transfer out of her bank account and into Bob the baker's bank account the $8 for the loaf of bread. $8 because I live in Palo Alto. Banks still form the backbone of our payment system, and today I'm going to focus on general purpose payments as opposed to the wholesale settlement of wholesale transactions, which for which there are other technologies involving stablecoins that I'm not going to discuss. So this is a natural arrangement that we have today. The bank account-based payment system provides natural gatekeeping for anti-money laundering, although there have been some significant lapses in that respect. It provides a channel for the implementation of monetary policy, and in particular, it provides for an elastic supply of money, which is critical, something that stablecoin approach depicted in this diagram does not do. So this is illustrates the creation by Alice of 500 stablecoin units or tokens, by which some issuer provides her with those stablecoins. Her funds to buy those stablecoins are transferred to a trust, such as the Calibra Trust, which then invests in safe assets, such as bank deposits. Now, as I mentioned, I think this is perfectly feasible, and that it can be done in a safe manner that will protect Alice from loss of her investment, that will keep the price of her tokens stable with respect to whatever that basket is. It could be a single currency or a basket of currencies, and that Alice will be able to effectively buy her loaf of bread or pay her monthly rent or whatever using those stable coins. So why is it that I don't think that this approach will end up being the one that most of you in the room that are responsible in the central banking community for upgrading our payment system? Let me explain why I think you will choose instead to upgrade your current bank account-based payment systems. This is already in progress, beginning with Korea, the Bank of Mexico, in Sweden, United Kingdom, and Singapore, in the European Central Bank environment, and as proposed in the United States, whether through the private sector or through the public sector, upgrading the bank account-based payment system is, in my view, a more natural approach. Not to say that it's easy. It involves a significant amount of operational challenges. The alternative for central banks, going back to the stablecoin situation, is to provide a central bank digital currency. Governor Lael Brainerd of the U.S. Federal Reserve System gave an excellent speech this week explaining why the introduction of a central bank digital currency is quite problematic. It introduces a tremendous operational challenge. The central bank essentially displaces banks in facing the general public, corporate and consumers, becoming responsible for both providing the currency and the currency arrangements, but also for monitoring private transactions to ensure that only legal transactions are being made. And that's an enormous disruption to the current payment arrangements that we have. Could be quite disruptive to banking, and it could put quite a lot of operational onus on central banks. There are technologies for upgrading the current bank account payment system. I live in Silicon Valley. This is only one of the approaches that I've been learning about. This is a cloud-based solution in which there are two ledgers, one facing the public and one in the interbank arena, that would allow very fast and effective secure payments. This one happens to be one suggested by TokenX. It's based on an open application program interface ledger system. So this is technically feasible, but implementing upgrades is not an easy challenge. The Fed's proposed new payment system is slated to roll out in 2023, and it does take time to develop these. Let me finish by just giving a selection of policy options available to central banks and other regulators of the payment sphere. So the first and most obvious one is to regulate tech entrants. And David has said that he's open to being regulated. Of course, that's fairly easy to say because he doesn't have any choice. He's going to get regulated one way or the other. It's not clear yet in every jurisdiction exactly how those regulations are going to be put together in a rational way. So that's one thing that central banks and other regulators can do, is to develop a comprehensive map of where the regulations are coming from. Are they coming from securities regulators? Are they coming from the central bank or other payment regulators? Actually, that's a recommendation that's in the G7 report that was issued on Thursday, a very excellent report I would recommend particularly. A second option is to develop a general purpose central bank digital currency, and I think that's going to end up being case by case. So Sweden, for example, is considering the introduction of its own central bank digital currency. China is actively considering this. And as I said, it's a very major step, and to some extent it's a one-way step. It's going to be difficult to reverse once it's done, because it is so disruptive. And because it's going to be a one-stop shop for payments. An approach that was suggested by Governor Mark Carney of the Bank of England is to develop a general global central bank or official sector digital currency. The case for this is, in my view, much less obvious. First of all, this could be quite disruptive to medium and small countries in terms of their monetary policies. Robert Mundell wrote in 1961 about optimal sized currency zones, and certainly he didn't envision that the optimal currency zone would be global. The interaction effects between a global stablecoin and local monetary policy implementation could be extremely disruptive. As you can tell, my general sense at this point is that the most effective approach for central banks is to foster an upgrading of their current payment systems. And I think central banks do need to get involved. If left to commercial banks, there's an inherent conflict of interest. Commercial banks have an incentive to focus narrowly on their own stakeholders. This is a public goods arena, and individual commercial banks need not internalize all the benefits of a fast and efficient payment system, and in particular, an open payment system that includes a lot of competition among banks for deposit taking and a lot of competition for payment services. So I think central banks do need to get involved on the links of the payment system, although banks themselves can still be the portal to the general economy. So that's about what I wanted to say, Thurman. Thank you.
Thank you very much, Dara. Augustine?
Thank you very much, Thurman. Thank you, David and Daryl. The advantage of being at the end is that you can sort of tailor your comments. The drawback is that your prepared remarks are useless. So, so let me do my best with these two excellent introductory remarks by my colleagues here at the panel. Let me start by saying that, needless to say, to embrace technology into the financial system is needed, is urgent, but also it's being done. Now, the key in all of these issues is that you have to embrace technology in the smarter possible way. I mean, a very famous phrase is break stuff and move on. Now, in financial systems, this thing that break things and then move on, the problem is that you leave a pile of mess there that somebody else has to clean. And usually that's the official sector. So I think the call for some orderly and collaborative process, I think it definitely is appropriate. I have to really and honestly and genuinely commend David for all what he has done. I mean, I think that there are very few examples of a single paper or single idea mobilize such an attention, so much devotion to explore what is good and what is question how can be improved the scheme. I think that you hit the right spot. I think that you hit the right fibers. I think that what is very attractive is that you are appealing for very tangible improvements in welfare in society. And I think it's very difficult to reject that. So the idea is how can we get there in a more efficient way from a social point of view. Definitely, and I'm a very strong advocate for public-private partnerships. As a matter of fact, if we think about the financial system today, I think it's an extremely successful public and private partnership. I mean, it's hard to. I mean, I think that right now in the margin, if it's very, I think, unfair to judge today's financial system just by the fact that you cannot do a remittance from Mexico to the U.S. Now, there are reasons for that, and I will address that later. But the degree of sophistication is there, and not even you know, the e-commerce that we see today and the penetration of internet in the different areas of society wouldn't be possible if we didn't have an extremely sophisticated and a strong performing financial system. Now, the issue with financial system, and I think that is something that characterizes it, is that you are really dealing with other people's money. And that obviously calls for a lot of regulation. And the second issue is also that for genuine reasons, we have imposed on the financial system AML-CFT. I have heard you said, and many other people say, how can it be that I can call my wife today in Basel at no cost through WhatsApp immediately, and why can I not transfer money? Well, if when you use WhatsApp, you would have to go through an AML-CFT process, you wouldn't be able to use the WhatsApp to do that communication. I mean, obviously, communication can also be used to promote terrorism and to do other harmful things. Now, imagine that you have to check that the other person that is receiving the call is a genuinely person that should be authorized into the network. Well, now that's what we are imposing on financial transactions. It has its objectives, and well, I'm not questioning them, and therefore we have to deal with that. That is a tremendously difficult issue to deal with, and for that technology, I think, needs to be used, and we need to be able to get to a point where this is not a hindrance to the development of payments, and we can do it in a very efficient way. Then there is the other reflection that we need to do, and which is where should we devote our efforts? I think that the proposition that has been put on the table, which is a global stable coin, which has this characteristic that it brings together the nature of money and the use of money in payments. Now, it's very curious that to be able to make efficient payments, which is the technology of making payments, I think really what matters, we need to design a whole new currency. And then on top of that, to design that currency, this construct has to import credibility from what we already have. So it seems to me that the most efficient way moving forward is to use all the genius of technology, all the force in technology, in really making payments effective and build on top of what we have. David said in his presentation, well, as today, at this particular moment, many cyber currencies are there. Well, guess what? That has been the history for the last 200 years. I will send you a book that Guillermo Ortiz, sitting here in front of us when he was governor, put together, which is the Central Bank of Mexico collection of bills and coins. It's probably the richest collection of that because in Mexico, especially in the revolution, we had the proliferation of money creation by hundreds of people. They are really nice, but they are useless. And you know, the truth is that through society, through time, we have gone through a full transformation of how to establish a fiat currency system based on central banks that can really take care of different phenomena that can arise when push comes to shove. Liquidity provision, I think it's something very important. Lending of last resort is very, very important. We have seen many attempts, many strong attempts to have a currency fully backed, and we have seen endless efforts for that failing. So the thing is, the truth of the matter is, where should we put our efforts? My sense is that the people that are, and David, I mean, they have huge talent. I mean, I certainly think that we could come with the formula, and not only with David, but many other innovators around, where we can optimize the use of technology with what we have, with what we have proven that it works, and that provides stability. So for me, I think that that probably should be the main policy objective. With respect to the list of solutions that Daryl put forward, I fully subscribe all of them. I mean, I think what will decide where we will move into is basically what is the most efficient way to get there. There is no question in the central banking community that this is an area where we have to move. As a matter of fact, each central bank individually are putting a lot of effort into this. And collectively, we're also doing it so. In the BIS, we have now something called the BIS Innovation Hub, where we are bringing together the different central banks precisely to think on these type of issues. We have a center in Zurich, Basel. We have one in Singapore. We have one in Hong Kong. We're planning to open one or two more in Europe. We're going to open one in the Americas. And the idea is precisely for central banks to really have a deep dive into technology, redouble its efforts in this direction, liaise with the private sector, and try to get a best possible solution. I think if there is enough collaboration, enough engagement early on, I think that we can save a lot of resources, both from the private sector point of view, because, you know, and something when I was discussing or thinking about these issues into Innovation Hub, I certainly consulted many people, and a very smart person that I think is sitting in this audience told me one of the key things you have to be able to do is to identify those projects that are going into the dead end and identify them on time and close them. I think that's one of the most hard things to do in this type of thing, but also is what happens the most. I mean, in innovation, and you know probably this better than I do, there are hundreds, thousands of attempts and very few progress. To maximize that, I think that early engagement between authorities and the private sector, the academicians, I think is desirable. That's something that we're trying to do. Certainly, Tarman and his team has been very supportive of all these efforts. The idea is to create a win-win and build up on solid bases that we have. For me, one of the solid bases that we have is all the construct about central banking. I think the construct of central banking is what really has provided trust to the financial system, and I think that's something that we have to preserve. Of course, we have to provide the platform for innovation to build up on top of that, and in that way serve society better. Central banks cannot do the last mile, not even the last 2 or 3 miles. That's something that others have to do, and there is plenty of space for innovation And of course, we need to go into the direction of cross-border payments. So that's my position. Thank you.
Excellent, thank you. That was very useful, Augustine. So I now open it to the floor, and I would encourage our speakers to respond to each other as well. You want to do so immediately, David? Yeah.
I would love to, thank you. Well, I wanted to address two things. One is, there is truly that narrative that the reason there's such a high cost for moving money around the world are actually the AML, CFT, and KYC efforts that need to be performed, and as a result, there's intrinsic cost coming from that gets passed on to consumers. And I agree that there is some cost. There is definitely some cost. But I do think that the main cost that is currently getting in the way of efficient, fast, real-time transfers is actually the fact that there are so many intermediaries and that the infrastructure is antiquated in many places, despite all of the very good regional efforts that we've seen, notably in Europe, in Singapore, now projects even here in the US. Those are all domestic regional payments networks. There are no really big advances in having a global infrastructure to move money around the world. So that's one point that I wanted to make. The second point I wanted to make is really relating to the approach. And I think that while I can't speak for all the members of the Libra Association now, I can share my view, which is that I think we're all in this because we have a lot of passion and drive to resolve these very issues for a large number of people. And we're not dogmatic about the approach at all. The white paper that we put out is one of many ways that this can be done. And we're definitely, as I think we've demonstrated, very open to a lot of feedback and having constructive conversations on alternative ways to address the very problem. What we're really focused on is really building the infrastructure. Now, whether it is the way we've described or other ways, again, very open to all of the input along the way.
Yes, please. Well, Daryl and then Augustine.
Yeah. So you've been hearing a lot about cross-border. I wouldn't, and I agree with the comments that have been made about the need to take out some of the costs and complicated infrastructure involved in cross-border. But I wouldn't want the conversation to get hijacked into one that's focusing mainly on cross-border. In my view, the situation domestically, particularly in certain currency zones like the United States, is a much more important one for central banks to face. The majority of payments are made domestically. In my view, the use case for Libra is going to be mom in San Francisco sends her daughter in Miami a birthday gift when she gets onto her Facebook page first thing in the morning on her daughter's birthday. It's going to be someone going into Starbucks and buying a cup of coffee, or deciding that it's simpler to, as in China with WeChat Pay and Alipay, to make their payments off their mobile apps. These Chinese solutions are extremely effective. They have displaced an enormous amount of bank-based payment systems, and they're entirely a domestic arrangement in China, with very rare exceptions. So before central banks get into a very long, complicated decision about global solutions and coordinating over either a global currency or get overly focused on cross-border payment, which I think the private sector can take care of, I think each central bank should focus on its home turf, and especially in places like the United States, provide a better solution to its own citizens.
Augustine?
Yeah, just, I mean, certainly what Daryl is saying is absolutely true, and I think there are tremendous efforts there. I think there are already very good results, and I think there is a lot of collaboration. Technology has been identified, and we will be able to deploy this in many, many more countries relatively soon. And I also agree with you that certainly I mean, basically what we have seen, and this is something we have seen in technology in different aspects, is that emerging markets have leapfrogged advanced economies just because they have been using technology. I mean, a clear case is China, for example. And certainly I think that advanced economies need to move forward. So that's one thing. The other is, I insist on, I certainly agree with you that the AMLC is just one problem and that there are many margins in which things can be improved. And I think one of the issues that probably we need to work more is to coordinate more among central bankers. And I think, yes, technology now helped us to reduce many intermediaries, for example, through tokenization. And I think we should embrace that. One important problem is that we don't have a world central bank. And that is something that we have to deal with. And it's not that I'm proposing to create a world central bank. But yes, that requires a lot of coordination. And I'm hopeful that we will get there. And having been governor of Banco de Mexico, one day I will need to have a drink with you to tell you the problems with AML-CFT, especially when you want to pay from Mexico to the U.S. and from the U.S. to Mexico. I mean, it's something that you just cannot imagine how complicated it is.
Well, there's a useful tension in our discussion between two approaches. One approach is build on what we have and retain the most essential values in what we have, especially credibility, and find more effective and efficient solutions to meet our needs. Another approach is to allow for some disruption, experimentation and disruption, but find ways of then making the disruptions mainstream. And I think both are valid approaches, and an early advocate of the latter approach was a very innovative entity called the Rolling Stones, about 60 years ago. And what they said was, you can't always get what you want, but if you try, sometimes you just might find you get what you need. Next question. First, Axel in front, Piyush at the back. 3 questions first. Axel first, yeah.
I think an issue we have to establish whether there is a market failure here or whether it is just competing different systems in the private sector, and others are happy to add to that. For example, we in the banking system are operating systems that, if they're based on sort of the same types of technology, are 100% backed by central bank money. Finality of payment and all of these things is assured, and everyone's welcome to the competition, but I don't really see the market failure of why we should need to go away from existing systems rather than have a competition among them, but under the same rules. And I think this was what Daryl was referring to. The rules and the regulatory part, once you get there, you will discover, as Augustine was indicating, this is heavily regulated industry, and it's even more heavily regulated if it works cross-border. And so I think we have to take away some illusions that we can sort of depart from the current degree of complexity, which is not there by coincidence. It is there by design. And it's very hard to strip that all away and let's start with a white piece of paper, and we could get to a better solution than the one we've arrived to over centuries of evolution of central banking and private banking collaboration. Thank you.
Please.
Piyush Gupta from DBS. So to Daryl's point, I think the problem of domestic payments is being solved and solved rapidly. So real-time domestic payments using mobile phone numbers or personal identifications is happening in India, in China, in Singapore, in Thailand. And in the next 2 years, almost every country will make that a reality. Technology makes it very easy to do. And as you said, Augustine, it's true that some of the developed markets haven't got there yet. Everybody will get there in 2 years. So the real problem is actually cross-border payments. And there is a market failure. There is a high cost of cross-border payments. But interestingly, if you really pass it out, more and more banks today are doing cross-border payments with no fee. The cost of cross-border payments comes from fee, from float, but most of all from currency conversion. And today you're already getting to a world where people aren't charging fees. Float is, whether you go stable coin or you go to the bank, float doesn't change. So really the cost and what you're trying to solve for is currency conversion. The cost of currency conversion is very high. Any solution you want to look for, therefore, is really solving for one problem. How do you get away from multiple currencies to a single medium of exchange? Which is why the need for a global stable coin or a unit of account which people can deal with across borders without having to convert every time you want to make a transfer. So in that context, it's not, I understand all the issues between stable coin and monetary policy, but that is not clear to me why the idea that Mark Carney suggested, or Governor Zhou from China suggested even 2 weeks ago, the idea of an official global stable coin, like an ESDR, IMF backed, why that should not be something we explore harder. It takes it and puts it squarely within the ambit of the public sector, but creates a single unit of account which can trade freely across the world. And you could put controls around it, around X amount of value or X amount of thing if you think there's too much volatility at a monetary policy level. Why is that such a bad idea?
So I have two, I'm not sure this is on.
Please, yeah.
Yeah, I have two concerns. One is let's consider a medium to smallish economy. Let's take Uruguay, for example. If I was the governor of the Central Bank of Uruguay, I would be quite concerned that I would be able to convince my citizens to keep their deposits in the local currency and to make their payments in the local currency. If not, then I lose my ability to implement monetary policy that's appropriate to that particular macroeconomic situation. The other concern is the coordination costs are relatively high compared to the gain in the use case. Coordination costs meaning if this is going to be a popular international currency, then monetary policy needs to be coordinated for it. And it's already difficult enough. The gain case is when you move, supposedly when you move money from currency A to currency B, that you're going to do it faster if you stop on the way to a global currency and making two transactions rather than one. So is it clear that with technology you can't improve on the current bilateral exchange rate system? I think technology can handle this problem rather than developing a new global currency.
Carlos Torres.
Yeah, I'm Carlos Torres. I'm the chairman of BBVA. I had a question for David, linking a bit of everything we have heard. I wanted to ask whether the emphasis of Libra is mostly on the payments, as seems to be the case according to the discussion today, so the payment use case, and also as Governor Carstens was pointing to, or rather that together with the store of value element of the currency. And if it is the first, the emphasis on the payment, whether then Libra is no more than just an instrumental token for that rail, that would not even have a consumer significance or even be a consumer brand?
That's an excellent question, actually. And of the things that I think we should have done a better job at is that we should have described this for what it is, which is its payments infrastructure, and the Libra token is a medium of exchange in between. So, you know, what I expect the use case to be is one where people get in and out of the Libra currency quite quickly to settle a payment on these new rails. But probably unlikely to use it to, you know, buy a coffee at Starbucks, given that all prices are denominated in, of course, local currency. So the current thinking, and the thinking has always been that Libra can be a stable digital asset that can be used to transact between two currency pairs, or a transaction that basically relies on these new rails. So the approach could be different, and it could be that you create a series of stable coins instead of creating this synthetic assets. So basically, just create dollar, euro, Japanese yen, Singapore dollar, et cetera, and just let people choose and use it. I think that would probably have a different type of use case as well, but that's also another alternative approach.
Next question. The gentleman at the back. Oh, sorry, Roger first. You had your hand up first. And then so gentleman in front, and then the gentleman at the back, and the lady in front.
Thanks. So I think, Daryl, you put your finger on the challenge, but also the beauty of Libra. So you've hypothesized a small open economy or a small economy with a central bank that is really focused and is doing the right thing. We also see that there are millions of people who are living in economies where central banks are allowing inflation to get out of hand. So one might argue that the benefit of a stable coin backed by a basket of currencies is it forces central banks to be much more disciplined in avoiding hyperinflation and thereby undercutting financial stability for millions of people. And in that sense, I think the competition is not between Libra as a payment system in the United States versus the US dollar. All of us in the US are not going to adopt a basket of currencies and deal with that kind of risk for local transactions. But for folks who live in places where central banks aren't as responsible as they are represented in this room, it might be that Libra is a great way to avoid the cost of irresponsible central banking. We need to at least put that on the table.
I'm going to take the questions together. So Roger's first question is an important one. There was a gentleman at the back there.
Thank you very much. Alexander Svoboda. I think to some extent we need to focus on what problems are we focusing on. And one single solution for all of them isn't going to do. Now, we talked about inclusion, okay? This morning we heard examples of how you foster inclusion in Kenya, for instance, and the means to do that. And we don't need a Libra or a stable coin to do that. This is work in progress, and these are sort of national problems. Second sort of concern was international payments, and in particular the foreign exchange market. Now, this does work at a wholesale level among major currencies. So here I think the question is, can technology, competition, new structures help us carry that on more efficiently to the retail level? And that's a different type of problem. Incidentally, I live in Switzerland, and I make payments sometimes in France, to France, for small amounts through the bank. Now, I found out that I was charged extremely highly if I wanted to do that transfer, asking my bank to do it. But if I do the electronic banking, I can transfer small sums of money to France from Swiss francs to euro from debiting my Swiss franc account with value next day. So that problem is also susceptible to things. Finally, I would say about the United States, for those of us who occasionally come here, have worked here, this is the most primitive payment system of any of the industrialized countries I know. Oh, and finally, the solution to the small country and so on, how about dollarization? That has been the solution and the disciplining factor, dollarization, euroization, and so on. You're not going to solve that particular problem by having some other type of currency. Thank you very much.
Thank you, Professor Svoboda. The lady in front, and then Larry in front.
Thank you very much. Constance Hunter from KPMG. So the gentleman in the back actually asked most of the question that I was intending to ask, which is always getting to the question of what problem does it solve? I had the privilege of interviewing Hikmet Ersek, who's the CEO of Western Union. And of course, Western Union has 50% of the global remittances market and deals with the issues of the current rails and cross-border transactions and currency. And when I asked him, why aren't you going to a more Libra-like solution? Why aren't you going to a coin solution? He basically said it wouldn't solve our two biggest problems, which of course are currency and AML. And the things that solve those problems for us are the use of artificial intelligence, machine learning, and technology that we already deploy. And then I would just comment that in the US, if I wanted to send money to someone as a birthday gift, I already have Apple Pay and Venmo in addition to ACH. And I agree our rails are a little antiquated compared to the rest of the world, but those solutions are already out there. So I think it's very important to very rigorously ask this question, what problem are you trying to solve?
Good point. Larry.
This is sort of a big picture question, and I've always kind of wondered about it, and this seems like a good chance to inform myself. Payments is a really important industry with a lot of important aspects. So's the distribution of food, so's transmitting electricity. There are a lot of really important industries. Central bank governors are usually regarded as the second most important person in their countries. G30 is a pretty high-level group. There are a lot of pretty high-level groups. Electricity distribution roughly never gets on the front page of the New York Times. Innovating about the payments technology, cryptocurrency gets on the front page of the New York Times all the time. Is this more important for some set of reasons than other things? Like electricity can blow up, cause fires, really can do a lot of bad stuff. And so it should get an entirely disproportionate level of policy attention and discussion than other industries because there's something special about payments. And if so, what? Or is this generate so much excitement among all of us because it's sort of in our sphere and it's stuff we've got responsibility for? But it has always seemed to me that these developments in payments are treated in a way that's way beyond other structural economic issues that seem very, very important. And, you know, another theory is that that's because finance has excessive control and influence and a role with respect to governments everywhere, would be another explanation. But I'd just be interested in anybody's reflections, and it's not that I have a theory as to what the right answer to this question is. I'm genuinely just asking.
Turn to our speakers. Augustine.
Okay, thank you, Chairman. Let me address first the issue that was raised by Roger about the competition that the third world countries or emerging market currencies face. You don't need Libra to face that competition. I mean, the incentives for you to perform and do your job is there every day. I mean, and I know it because I have been a governor of a country that has had its challenges. So, I mean, you don't need to have another construct like that. Then the issue of a global stable coin. I think that the challenge to build this in a reliable way is huge. I mean, I think that at some point, certainly there is plenty, from my point of view, there is plenty of room to have utility settlement coins that facilitates settlements and that reduces a lot of the links that that David was alluding to. But to have it as a real retail, broad-based currency, I think it's extremely difficult. I think for cross-country payments, and I think that's what Daryl hinted to, I think the solution is to make Forex transactions far more efficient. And I think that the technology is there, and I think we can do it. In today's life, it's really inconceivable that in many financial transactions we have delayed settlements of transactions. I mean, not only in Forex, but also in securities transactions. And I think a lot of progress you will see there, and that will make the Forex transactions to be very, very efficient. And I think that also is something that will solve the problem of a Western Union. Also, the technology for doing the cross-border payments based on the systems we have today is already there. And again, one of the main hindrances is AML-CFT. One item, I will take a stab at Larry's proposition. I think that the main reason why payments have become so important, is because I think that through many, many, many years and decades, commercial banks, and I would say also to some extent, because I want also to take some of the responsibility, we took for granted the system we had out there. And I think there is a tremendous room for improvement. I think that a key challenges that banks face is the fact that they have an image of being backward in terms of technology. They don't like to go into the internet. They like to go into internet to surf, to chat, but not to do a transaction, bank transactions. Why? Because they usually associate banks with issues. Either the payment is not made in time, they are going to be charged commissions, they are going to be charged interest. So the challenge that banks face is much more broader than just payment. It's just how do they relate with people. And I think one of the main challenges that they face is how can they compete with other ways to accessing electronic payments through non-bank portals and have their own access pages competitive. I think that's an issue that commercial banks will have to face, and many of them are doing it. I mean, I can see here two examples where they're moving very fast in that direction. But yes, it's a huge challenge, and I think that's I think people care a lot about how they pay and how much it costs to them. I think far more than electricity, unless you're from California.
Darrell.
I'm going to try to address the last two questions in one go. I think Augustine had it exactly right. Payments, everybody every day faces payments, so it's extremely salient. And there's a lot of dissatisfaction. If you think especially among the 20-year-olds who are used to just opening an app and have to go through such a chore to move money or to pay a friend. China, it became much easier, and the United States and other countries are far behind some emerging market countries. M-Pesa is a good example of how this can happen rapidly. 2.5% roughly a credit card fee. My local sushi shop in Palo Alto has stopped taking credit cards unless you're willing to pay an extra fee because it's very expensive for them to pay those interchange fees. The rest of the world, it's not so bad. Vendors are waiting a couple of days to get their money. So the system is quite antiquated. It deserves an upgrade. And the reason that we in this room and when central banks meet at the BIS with Augustine, the reason it's important to them is that depending on the choice they make, they could get it quite wrong. It's possible to make a choice for how to upgrade the payment system to meet the demands of citizens that would make monetary policy implementation very difficult, or that would disrupt the banking system to the point that the central banks would own it and now be responsible for privacy concerns, operational risks, and many other issues that they probably wouldn't want to face. So I think this is the time in the next couple of years in which those meetings are going to result in decisions that are going to be quite consequential.
So I want to say that that there's one really stunning thing that came out from questions and generally the panel, which seems like a lot of people in the audience and constituents seem to believe that everything is okay, that the current system is either working well for constituents or that we're on the path of solving all the problems. And I've spent a considerable amount of time talking to the very people that we hope to serve, and they really disagree. Someone made the comment that it's fine because in the US we have Venmo. Turns out I acquired Venmo when I was running PayPal, and this was 6 years ago. You can still not make a payment between Venmo and PayPal, which are part of the same company. So the problems are wide-ranging. There's no interoperability to move money around. There is no ability for different entrants to apply more competitive pressure to the current payment systems. It's really a very closed club, and as a result, it's really hard for new entrants to compete effectively. We clearly have an issue, which is that most people that have that $30 Android device or smartphone that I was talking about earlier, while they have access to the world's knowledge and information, they still cannot have access to digital money in any cheap way. In many of these places, while there are real issues that need to be addressed when it comes to identity and enforcing these things, I do think that novel approaches to AML and CFT that doesn't really rely exclusively on self-reporting from licensed entities, but enables real-time information to flow through models and more visibility for law enforcement and regulators is actually going to enable to reduce costs in a significant way for the very people we want to serve. So the one message that I want to leave you with is that we can actually work together to solve these issues, and call me or color me less optimistic that the current status quo and path we're on is actually going to solve these issues for the constituents we're supposed to serve.
So I think, David, it's fair to say that all three speakers do think that the status quo is not good enough, and we do want to find a better solution, and we have to keep our minds open as to what will be the most effective solution, public and private. We shouldn't rule any options out at this stage. We actually have run out of time, but because Andrew Lodge had his hand up for a while, if you can just make it very brief.
Rather a simple point, but the thing I don't understand is this. We're talking here about the inefficiencies that presently exist in transferring from Alice to whoever, wherever. What I don't understand is why, in order to make the improvements that are necessary, we have to also bundle together that which is transmitted, i.e., the token, the money, the cash. Why do we have to do both? Particularly if it's possible to improve the processes that we presently have to a significant extent.
Darryl?
Mr. Lodge,
very quickly.
I think your comment just resonates with the point that I made. So I'm not going to elaborate on that.
So I don't think we absolutely need this, and we could do it differently to the point I made earlier, which could be that instead of just having a synthetic unit, a settlement coin, or however we want to call it, we could have a series of stable coins that are actually, a dollar stable coin, a euro stable coin, a sterling pound stable coin, etc., And that could potentially work as well. And I think that's one of the options that should be considered. I do think it's important that the concept of creating a token on top of a ledger, such as a blockchain, is actually important because it enables you to rely on this new interoperable infrastructure to move money around. And if you don't do that, and if you rely on just taking the dollar in its current form, you still rely on much of the current infrastructure, and as a result can't solve the issue. But completely take the point that we may or may not have benefits and drawbacks from having a synthetic asset in the middle of all of this, and we could definitely approach this with having a multitude of stable coins that represent national currencies in a tokenized digital form.
Well, on that note, let me conclude this session. Thank you very much to our three speakers for a very good discussion. And thank you to the audience, and please join us outside. We have a range of edible tokens available for anyone.